أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله وعلى آله وصحبه أجمعين أما بعد أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري. Hello, Assalamu alaikum wa rahmatullahi wa barakatuh. Am I audible? Yes. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. So Alhamdulillah, yesterday we had a session on the basics of how to invest in stocks the halal way. We had discussed about what are the different types of terminologies you need to understand, what is the approach in which you have to look forward to the stock market industry, and you also how you're supposed to, what are the things you're supposed to consider in a stock before you consider it to be halal or not. We also went through different forms of graph patterns as well as a basic outline on the candlestick theory. So we hope that inshallah that you are able to relate to what we are saying and be able to connect with all the basic fundamentals which we have discussed in regards with the stock market investing. Today we'll be discussing more in regards with the attitude and the mindset to approach the stock market with. I personally consider this as a very important topic when it comes to stock market investing, is the mindset and the attitude with which you approach the market, which matters the most, not only with investing into the stock market, but investing into any industry as such. So this is something which is a very important factor when it comes to the investment industry. And we will also be talking in regards with live market trading. We will take you for around 15 to 20 minutes. We'll teach you in regards with how we generally surf through a company, what we see in terms of fundamentals, and what we will do in terms of investing in the platform, that is the broking platform. Then we look forward in regards with some investment strategies which will be discussed from the famous investors who have been established globally in the last decade. And eventually we'll look forward to close the session with some basic understanding and some facts about the investment industry in the stock market. So inshallah, let's start our session today with the first topic, that is the right attitude that is required for you to invest in the stock market. Now, there are a lot of things in this which I probably would have discussed during the session yesterday, which I hope that you remember. And it's important for you to understand that these things, no matter how many times are repeated, are the most important factor in investing in the stock market. And if you are able to master these things, inshallah ta'ala, you will be able to see a significant difference and significant development in your investment portfolio. The couple of things which I like to discuss about is, firstly, be an investor and not a speculator. As I discussed with you yesterday, that risk comes from not knowing what you're doing. So it's important that you're able to analyze, you're able to understand what are the places you have invested in, where are the places you would like to invest in, and what is the industry, and how does that industry get affected by any news which comes into the market or anything which goes wrong. So you have to be able to completely understand an investment before you make it. You have to go in with a dedicated mindset. You have to go in with a particular time frame in mind, and also some at least a target price. Like if you're entering into an X value, you will exit at X plus 10 percentage or X plus 20 percentage. Working in this model will help you, inshallah, to create a more confident mindset. This will help you also to be consistent in the market, even though even though the market fluctuates, even though the market crashes, it will keep you at peace, it will keep you at ease, because this will help you, inshallah, look at things in a different perspective. Because when you invest as an investor, the other things, the other fluctuations of the market do not affect you anymore, because it's always the opportunity which you see and not the risk, because you are aware about the industry and you are aware about all the other things which are related to risk in the market. The second attitude which I would request you to inculcate is that you have to always remember, money is a good servant but a bad master. A lot of people have to understand that when you are investing in stock market, when you have a particular target in mind, once you achieve it, it's better you exit that uh, window or exit that particular stock. Because if you have achieved your target and you're trying to wait for something more, it means money is becoming your master and you are not taking control over what the situation is. Always make sure that you are able to get your targets right. You always make sure you're able to achieve those targets in that time frame, and make sure that once you achieve that target, you are able to exit it, and you are able to enjoy whatever you have achieved. Do not look forward for what you could gain more, or do not look forward to see what you could have lost more. It's important that you are satisfied, you are content with what exactly you have, and inshallah that will help you take significant control over the market, that will help you be emotionally detached, that will also help you to have a very calm mindset when it comes to entering the market, because this way you will be able to enter and exit in a disciplined format without any distractions in place. This saying was particularly said by the famous Benjamin Graham, who's supposed to be the father of stock investing and also the famous mentor of Warren Buffett. And he was also one of his teachers in his college, which he had studied in Chicago. And the book which he had written is considered to be a famous textbook of stock market investing, that is called Intelligent Investor. So an intelligent investor is about character and not about brains. So it is the character which you possess, it is the calmness, the demeanor which you have, which will help you become a better investor and a better strategist when it comes to getting the returns on your dividend, getting the returns on your investments. Thirdly, invest what you can afford to lose. This is something which I had mentioned yesterday during my session, that it is important that you have to have your peace of mind. It is important that you have to invest what you can afford to lose. Only when you approach a particular investment with that particular mindset, you're able to be detached with your investment, you're able to have that calmness in your mind, and you're able to take the risk which you're looking forward to endure to get the profitability you need. If you're investing what you cannot afford to lose, then whenever there is a risk, whenever there's a fluctuativity, it will affect your mindset, it will affect your emotional stability, and you will end up getting attached to the stock, and you will end up making irrational decisions during the course of an investment. The fourth character which I would request all of you to consider and also understand is, there is always an opportunity and you have to wait for the right one. Now, this is something which, in my personal experience, has helped me a lot, because there was one particular point of time when I started my career, and for almost 2 3 years I was constantly taking everything which came my way. And I used to make sure I don't say no to anything, because you always feel that, once there's an opportunity, you have to take it, you cannot miss it. But in that process, I ended up taking all the opportunities which came my way, which ended up making me master of none, basically. I was putting my effort everywhere, but I was not able to multiply it. I was not able to take the reward of it the way I wanted it. So it's very important that you understand that opportunity is going to always be there, but it's important to know when to say no. There was one particular investor which I went to, and he was a person who's been successful in his industry, and he has been a very significant figure in the investment industry. And I went to him and I was telling him that this is what I've been doing, and he's been my mentor. He told me, Jubran, you have to understand when to say no. The moment you learn to say no, that's when you are actually growing. And this actually helped me a lot, because instead of me searching for opportunities, instead of me pouncing on all the opportunities I had, I rather waited for the right one, and I was prepared for that opportunity. And once I got that opportunity, I tried to make sure I make the best use out of those opportunities which I've got. So never think that in stock market you do not have an opportunity. Never think that you're going to miss on an opportunity, because 99% or 98% of the people in the stock market end up investing emotionally, or end up investing more irrationally, because they feel this is an opportunity. If this goes, will not get another opportunity. All successful investors are people who are calm and who know there is always an opportunity in the market. You just have to figure out or find the right one. Make sure that when you find the right one, you're prepared for it and you take that opportunity as it comes. I will also like to share with you a few investing principles, because now this segment of the workshop is where we are going to talk to you about the mindset, the investing principles, the way you're supposed to approach an investment, the way you're supposed to program your mind to invest in the stock market. In my particular understanding, the whole of stock market is not more of technical things, but it is more about practical understanding and personality and character, which I've been sharing from yesterday and today. So we will be focusing more on the fundamental aspects in terms of personality, in terms of basics, in terms of character, in terms of analysis, which will inshallah help you to become better investors in the stock market, not only in the stock market, but also in personal life, inshallah. The few principles which I like to share with you is, first, When you're investing into a company, try to see the management, try to see and make sure the management has integrity and has necessary talent to shine in the particular industry. Now, if you look forward for companies like Infosys or Reliance or TCS, you will always see these are companies where in any crisis situation, you will always see them shine. Now, there was a recent incident where in the last 1.5 years, Infosys was significantly hit in the stock market, and the stock price fell from 950 rupees to almost 600 rupees for no reason, because there was a whistleblower saying that Infosys is being corrupted from inside. So the moment that news spread, the market collapsed, and immediately Narayan Murthy and Nandan Nilekani, who is currently the chairman and CEO of Infosys, he came over the board. And once they took over everything, and now Infosys immediately in 3 months regained back to its spot of 1,000 rupees. Now, what I mean to tell from this is what this example proves is strong companies with strong fundamentals and good management will always shine no matter what, in any crisis situation. So what you have to consider is, you have to consider the past track record, the current track record, and the future plans which the company has, how they've handled failures in the past, how they've consistently performed in the past, because a company with the right management is the actual core fundamental of a successful investment. Now, if you are investing into the right person or into the right management, you will see that the company is growing, or the right team, you will see the company is growing. This is not only for the stock market related services, but in any part of investments. If you see, it's the most important factor of investment is to invest in the right team and to invest in the right management. The second principle is invest on facts and not on emotions. A lot of people end up investing on emotions and not on facts. The market is going up, let's invest. A lot of people are making money, let's invest. The newspapers are constantly having headlines of Sensex going up 500 points, 800 points, so much of money coming in. FII is investing, DII is investing. So a lot of people investing in the market. These emotions are making a lot of people fascinated about stock market. Like, for example, during the lockdown, when the stock market was crashing during the whole of March and April, and then when the stock market was significantly rising during May and June, a lot of people kept saying, we want to invest in the stock market, we want to invest into the stock market. There was a what do you say, gush of inquiries in regards with how to invest in the stock market. We want to make money, but they had no idea in regards to what are the facts and understanding of the stock market. Now, this is something which is an emotional drive towards doing something. I would always request and I will always suggest that whenever you're investing into the market, you invest on facts and not on emotions. It's very important that you consider a company's facts. It's very important you give the benefit of doubt to the company, but it's also important that you critically analyze the company in the most negative perspective possible and see whether it is meeting all your criterias to invest into the stock market. So a particular company, when when it is fact checked, you will understand that it will go through any difficult scenario in terms of investment, and you will have a very deep confidence in the company in terms of investment, and you will be able to see that in any situation you will be able to be calm because you have invested on facts and not on emotions. The third principle which I would like to share with you is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now, what happens is, most of the time, when there is a rally, we end up buying companies at a fair price. You have to understand one of the most important factors of investing is, what is the right value to buy a stock. Now, this is the most important and the most toughest thing to do, because most of the people, not even people who have been into the industry for 10 years, have an idea of how to check the exact value of a stock. You have to be able to analyze what is the exact value of the stock and what is the price which you're paying. Are you paying a high price, or are you paying a undervalued price for a stock? Say, for example, during the last 3 months, Berkshire Hathaway, which is one of the biggest stock market investing companies in the world, which is again run by Mr. Warren Buffett, one of the famous investment funds, Blackstone, and many other hedge fund companies kept approximately around $300 billion in cash when the whole market was even crashing, and then the whole market was going idle, because they felt that no stock was perfectly valued. They did not invest in anything in the stock market because they felt that no stock was perfectly valued. They felt it was either overvalued or they felt that it was manipulated. So you have to understand that people with such heavy cash surplus are also not investing in the market when they can actually make money just by putting their money in and taking it out. Now, this means that a strong investor is a person who fundamentally has very strong principles, and he does not budge on those principles no matter what is the situation. You have to be able to be strong and firm on your principles. You need to know exactly at what value you're buying the company. You need to understand the value at which you're buying the company is fair or is it wonderful. That is exactly what you need to analyze, and that you can analyze only by finding out what is the exact intrinsic value of the company and what is the actual value which the company is worth for and what is the value of the stock. So many a times you have to compare the earning ratio with the dividend ratio to understand what is the exact value of the stock, and this will come only by constantly analyzing multiple stocks or studying multiple companies, which will help you understand what is a wonderful company and what is a fair company. Buy companies only which you understand. That will be the fourth principle which I would like to share with you. It's very important to understand the companies which you're buying. It's very important to understand the industry. It's very important to see what are the things which affect those industries. This way you'll be able to be confident in terms of investment, and this way you'll also know what are the future prospects and where are the opportunities which are going to come. Now, if you understand your industry very well, you will know in this particular scenario you have to exit the stock. The stock might be in profit, but the moment you can predict that this particular industry can get affected because of this scenario, this happens only when you understand the industry well. This happens only when you understand the particular stock well. So this way you can actually foresee or predict within yourself that okay, this stock might crash or this stock might go up, and either we can add more of the stock to our portfolio or we can immediately sell and exit this portfolio. The another principle which I'd like to share would be don't sell unless the company doesn't change its fundamentals. The most of the time what happens is people end up selling the stock, people end up holding a stock for a significant period of time, but they end up selling the stock or they end up giving up the stock because they feel the market is fluctuating or because they feel that the whole market is falling, so it's better we take off our money. But constantly make sure that you believe in the fundamentals of the company, make sure that you believe in the research which you have done in regards with the fundamentals of the company, and follow those fundamentals and try to see you can how you can hold on to those fundamentals, because most of the time you are almost there and you just exit just before a rally. So if you have seen a lot of companies or a lot of investments which you make, especially with us investors, stock market investors, what happens is we invest into a particular stock, we wait for almost 3 months, 4 months, and correctly when we decide to sell it, and immediately after we sell it, we'll see in that particular day the rally will happen, or the second day the rally will happen, and then you end up breaking your head saying, oh, why did I sell the stock? This is because we never had the firm belief in the fundamentals of the company. If we had the firm if we had the firm belief in the fundamentals of the company, we wouldn't have been affected by the fluctuativity of the price or the trend of the market, whether it's going up or whether it's going down. The next point would be when you see great opportunity, take it. Now, there is a difference between taking all opportunities and there is a difference between taking great opportunities. Now, there has been a lot of times in the past where this is something called the thumb sucking rule. That is, when you see great opportunities, take it. But the investors always suggest that don't let your decision paralysis to hit your mind when you're seeing a good opportunity, because when there is an opportunity, most of the time what happens is in stock market, you analyze it, you know there is a good opportunity, you know there is a good price, but you end up not involving yourself in it because you just do not know whether you should take it or not, just because you have a fear or you have an inhibition for this particular stock or this particular industry. They are not always all the time you get great opportunities. You get opportunities all the time, but there are only few opportunities which are great. Like this, probably I would have cost a lot of money to my company by not taking the right opportunities at the right time. Not that we have lost money, but we probably could have made much more if we would have taken the opportunities in the right time. We just let it be because we wanted to be more safe, we wanted to be more secure, and we wanted to be more in a very what do you say, defensive mode, because we felt that we couldn't be a little more aggressive than what our investment portfolio or investment strategy is. Next, it will be try to buy companies below intrinsic value. Now, as I mentioned to you, that the most important factor in considering the value of a company is intrinsic value. When you're buying a company below intrinsic value with a margin of safety, you will understand that this is one of the most highly proven investment concepts in the world. You have to understand how to figure out the intrinsic value of the company, and you have to figure out how to you have to learn how to figure out the margin of safety of a company. If you can consider these two factors in any stock market investment, 99% of the times you will see your stock investment will be successful compared to anyone else in the market, because this is the most core fundamental principles of almost all successful stock market investors. They know exactly what is the right price to buy, and they know exactly what is the margin of safety. Keeping this, they're able to easily make a good return on their investments for a significant period of time. How to calculate intrinsic value, or what is a basic understanding of intrinsic value? I gave you an example yesterday. Say, for example, you're buying a company as a stock, but consider that you're buying the whole company in a complete format. So if you're buying say for example Berkshire Hathaway for $100 billion, what you have to consider is, when you're buying this whole company, in how much time can Berkshire pay me back? Now this is something which you can calculate in terms of a theory which is called rule of 72, which I'll be coming in the subsequent slides, where I'll be talking to you about the rule of 72. That is how you can calculate your investment return, and when can you actually get your complete investment return, and how much frame of time. So intrinsic value is very important. You have to understand how fast the company can cash you out if you're making an investment in the company. With that, you will get the answer of how strong the company is. Always think you're buying the whole business and how fast they can cash you out. This is exactly what I was mentioning in terms of intrinsic value. And you have to also add something called a margin of safety. If you add this, probably you will see that there is a significant benefit in your investments, and your investments will inshallah stand out from the other investments which you make in the market. This is something which I've taken from the famous book Intelligent Investor, that is by Benjamin Graham, which is one of the best investment books which has been written in the past. Probably if I had the book here, I could have showed you how it is. I would suggest that everyone has this book with them, because it is important to go through this book if you are really passionate about stock market investment. This is something which will be highly beneficial for you in investing into the stock market, and this is something which is a must have for stock market investment, because this book has a consolidation of all classical rules of investment for the last 100 years which have been available in the market. Stick to a formula by which you can make all your investments and you will do fine. So as I told you, that the best way to invest into the stock market is not by doing big things, but by doing small things which are fundamentally right. Yeah, probably I had the book here with me. This is the book, The Intelligent Investor, by Benjamin Graham. And you can see in this book, it is always mentioned that this has been prefaced and appendixed by Warren Buffett. So this is a book which Warren Buffett himself tells that was highly beneficial for him, and this is something which has been the core fundamental of investment. And the second book I would suggest probably would be Money Master the Game: 7 Simple Steps to Financial Freedom by Tony Robbins, which has been one of the best books in regards with a consolidated approach of investing into the stock market by Tony Robbins. Yes, without doubt, you'll see a lot of non-Sharia compliant options there as well. But it is the strategy and the mindset and the approach of all big investors towards the market which has been very useful. So as I told you in the previous slide, that stick to a formula by which you make all your investments and you will do absolutely fine. Now, the biggest challenge to do in stock market is to actually stick to your basics, to actually have simple mindset. A lot of people want to study more, learn more, different graphs, different strategies, what this investor is doing, what that investor is saying. But the main key to stock market investment is very simple. It is just stick to a basic formula. And this is exactly what Warren Buffett has been telling for 40 years. And he tells that this is exactly why people still are not able to follow this, because stock market is such a luring place that you cannot stick to fundamentals, you cannot stick to your basics. So if you're able to stick to a basic formula, if you're able to stick to a particular fundamental, if you're content with what you have, you will absolutely do fine, because it's not about making more money. It is not about doing big things. It is about having the right discipline and having the right mindset. The next thing will be, never trust the Mr. Market. He can be very irrational in the short and midterm. Whenever you consider to outsmart the market, whenever you try to think how to beat the market in short term or mid term, how to make money, you will never be successful, because Mr. Market is not something you're supposed to trust. All what you're supposed to trust is your own mind, your own analysis, and go into the investment with full conviction if you are sure about the analysis and the study you're doing. If not in short term, if not in midterm, inshallah, it will surely reap rewards in the long term. Last point, which I could share from this book, will be analyze for the long term, that is the fundamental analysis. Protect yourself from losses. Make sure you always diversify your portfolio and always average. As beginners, it is important that you protect yourself from losses. There's a very famous saying: follow two rules to be successful in the stock market. First, never lose money. The second rule is never forget rule number one. So you have to understand, in stock market, the most important factor is to not lose money. People think that if we lose money, probably we can make it tomorrow, because stock market always has opportunities and you can make money faster. But you do not understand, if you're investing 1 lakh rupees and you're losing 20,000 rupees, to make 20,000 rupees from 1 lakh rupees, probably you have lost 20%, and your corpus right now is 80,000 rupees. Now you're thinking, I'll make the 20,000 back. But from 80,000 rupees to add 20,000 rupees, you need to make at least 25 to 30, almost 25% returns. So you can understand that every time you make a loss, you have to actually make much more with the existing capital which you have than the money you have lost. So it's very important that you protect yourself from losses. If you're making a small loss, no problem, take it and exit, but don't try to take a big loss, because every time you try to think that probably now I'll be able to make my money back, or now I'll be able to recover my losses, you'll end up losing more money. So always try to diversify your portfolio, always try to average it. By diversifying, you will see a natural hedge in your portfolio, and this way it will, inshallah, it will naturally protect your portfolio to a certain extent from market fluctuations. And don't go crazy for profits. Value investing, it's very important that you go, as I mentioned in the last 2-3 slides, it's important you go basic, you go with fundamentals, and you go with the formula that if your target is to get this much in terms of return, be happy with it. The moment you get it, exit it. That is as simple as that. Do not get greedy and do not try to go for crazy profits. Also, just to mention, add up something here. You would have seen the most successful businessmen in India are Marwadis and Chettiars, or many other people who are into the business for generations. You will see the core value, the core principle they follow is they make small margins on a daily basis and in volume. So what they do is, even if they get 0.5 paise or even 1 rupee per day, they're happy to exit and get their margins. This is a very successful principle, not only in stock market investing, but in practical life as well. Never consider heavy returns. If you get small margins every day, drop by drop, you will be able to see at the end of a particular year, you will see a significant a cash pile with you available in the stock market. So make sure you go just by few little returns in a short period of time, or at least a medium frame period of time. Get your target and you can exit the market, and this way you will see a significant difference in your investment portfolio, inshallah. Attitude is everything, as I've discussed. Do not be greedy or impatient, and do not try to make a heavy investment when you're starting. Make sure when you start your investments, you start it with a very low profile investment. Don't go heavy on capital. Don't go with 50,000, 1 lakh, 1 lakh 50,000, probably whatever you can afford to lose, probably, so that you can feel comfortable and relaxed. Try to invest slowly, steadily, study the market. Don't get in a hurry. Go only when you're confident. Enter only when you're confident, and do your basic paper trading initially, which I discussed with you yesterday. Then start studying stocks. Slowly start putting little money. Probably you can add with 2 stocks or 3 stocks or 5 stocks. Feel the vibe of the company. Feel how the company talks to you. You probably how you sink in with the company, and eventually you will be able to add more to the portfolio, inshallah. Rich Dad or Poor Dad. Now, this is a very important book, or this has been a very successful book in the past, where the mindset of individuals, how much of difference it makes. Rich Dad or Poor Dad has been a very important. Rich Dad Poor Dad has been a very successful book when it comes to investing with the right mindset. Now, here it is how two people with a positive mindset and negative mindset look at a particular situation. Now, a person who has a positive mindset or a growth mindset looks tells always probably a failure is an opportunity to grow. But people with a fixed mindset never consider failure as an opportunity. Rather, they use it as a reason to say that this is what my ability is, and I'm limiting myself to this. I can learn to do anything I want. They're always open to learn more and grow more. A person with a fixed mindset is either I'm good at it or I'm not. So if I cannot make money in stock market, it means I'm bad at it. That is not how you're supposed to approach it, because the moment you feel that there is something which you're not good at, or the moment you feel that there is something probably you're making mistakes or you're losing money in it, doesn't matter. Hold, learn, study, try to approach it slowly again. Just because you're losing money doesn't mean you should give up. You have to understand that's the reason we're saying go slow, go steady, go very small. If you're making mistakes also, it will not pinch you, but constantly you'll be learning, and at least your mindset will not get affected. Challenges will help you to grow. This is something which you have to program your mind with, and the more challenges you face, inshallah, in the stock market, the more it will help you understand and grow your portfolio as well. My effort and my attitude can determine my abilities. This is something which works a lot in the stock market. The effort and the attitude with which you approach the stock market will significantly determine the results which you get. Feedback with mentors, feedback from industry specialists will be extremely constructive for you to invest in the market. Be inspired by the success of other investors, be inspired by the success of other businessmen, and try to do new things. This will inshallah help you to have a positive mindset, and this will help you to come out of the negativity which probably the last 6 months or 8 months has brought into a lot of people's life. Don't question your potential. Don't get affected. Don't get frustrated with the cash flow situations. A lot of people are going through a lot financially, mentally, emotionally, health wise, family wise. So this is something which we should not let it affect our mindset, our cash flow. We all need to understand what has to come to us will come to us no matter what. It is just our ability, it's just our positivity, inshallah, which will help us to grow. And it's important that we share this positivity with everyone else as well. Now, what is the role of psychology in stock market? In the sense, not our psychology, but how does the stock market control your psychology? Now, because we have been speaking about basics, about fundamentals, about how you're supposed to study a stock, or probably we'll show you how to invest, or what you should go through in terms of analyzing a particular stock. But what we have to understand is stock market has its own psychological traps, and stock market has its own psychological concepts which probably it lures you inside it, and you end up getting stuck again and again as a rat race. So we will talk about a few concepts in terms of what are the psychological impacts stock market has on you, and what is the industry, how is the industry currently faring, and probably what are the good industries which can be in the future, and what could be the growth options. Because right now the question is not about what you are doing now, the question is about how it's going to be in the next couple of months or couple of years, and exactly how you can actually not get significantly affected by the stock market and lose money. It's about how you can take control over it and how you can make most out of it. So there are a couple of psychological impacts or psychological factors which the stock market has on you. So this is called behavioral economics. Basically, there's a topic called behavioral economics, where you talk about different impacts an economy can have on a person's behavior. And based on this behavior, there are a lot of economical products in the market which are used to take money out of individuals and lose money as well. So the first type of investors are active stock market investors, people who are daily sitting in front of the stock market and trying to make some money intraday, future and options, something or the other, but they want to make some money daily. So these are the people who are obsessed, who are addicted to stock market, and these are called active stock market investors. No matter what, how much money these people lose, they don't care. All they believe is they'll make money in the future, because for them stock market is more about addiction than making revenue. Passive stock market investors. Passive stock market investors are the long-term investors. These are the categories under which Sharia-compliant investors come, because when you invest into a company and you have invested in the fundamentals, probably when I personally invest in a company, I don't look at the stock market daily. I look at it once in 10 days, once in 15 days, or probably I look at it when I know that today the stock market will have high fluctuativity, or probably when I feel that today there is some good news coming up and I should consider the stock market, or whenever I feel there is some important news in the market, is when I have a look in the meanwhile. But probably I just have a look in my portfolio once a week or once in 2 weeks. So I'm very passive when it comes to my investments. It doesn't affect my mindset. It doesn't affect the other things I'm doing. It doesn't give me restlessness during the day. I'm not constantly worried about my portfolio. This is exactly what most of the initial investors don't do, because they're so passionate they immediately keep checking the phone. Like when I started my investment portfolio, probably around 9 years back, my routine was I get up in the morning. The moment I open my eyes, the first thing I do is I open my phone, and I will see the stock market from 9:15 till 10:15, 10:30. I'll forget everything. So I will pay Fajr, I will sleep, I cannot wait, because I used to be so eager and so anxious when the stock market will start. So after Fajr, I used to end up sleeping just because I wanted to that time to while away. And I get up exactly at 9:15, and immediately I'll wait when the stock market will open. I will watch it the whole time for 1.5 hours, then go to my office, and from my office also keep checking it every half an hour, 45 minutes, 1 hour. So this is something, this addiction, this obsession is something which comes only when you do not know about the fundamentals of the company. This will happen, probably it happened to me for almost a year. It became a routine where constantly I had to study about different things. Before I sleep, I at least used to spend at least 1.5 2 hours just studying and obsessing about what I can do or how I can do more. Then when I kept learning more, I realized that it is not about what you do on a daily basis. It's about what you do right is what will get you the right returns you want. Now, emotional stock market investors, there are few people who invest in stock market with an emotional mindset, where they end up getting attached to the stock, they end up getting married to a stock. They get so attached to a particular stock that, because even though they're losing money, because they've held that stock for so long, because they have watched that stock, observed the stock for so long, they end up having an attachment towards that particular stock. Or probably just because you have made good money in that stock in the past, probably a couple of times, you just cannot afford to give up that stock, because you feel that you need to have that stock, or probably it is something which you surely need to have it in your portfolio. Copycat stock market investors, now there are few people who invest in the stock market just to copy other people, or they invest into the stock market just because one person is investing in that stock, I will also invest in that stock. That is not how you're supposed to do, because when one person invests into the stock market, he invests it with a particular mindset. Like for example, when I invest in my stocks, I invested with a particular mindset. Now my friends, just because I invested, if they invest in this particular stock, it has happened once or twice, uh, they they were in the stock hoping that I'm there, but I knew when to exit. I exited. So after a month or so, he says, Jubran, what happened? The stock has gone so down. I said, which stock has gone so down? Like this particular stock which you had invested in a couple of months back. I said, yeah, I did invest, but I also came out because I got my target. So he was like, okay, you didn't tell me. I said, I did not know you invested in a particular stock. And why did you invest blindly? Because I had invested. You have to invest understanding the stock yourself, so that you know exactly when to exit and when to enter again. So this is something which is important. Stock market should not be copied by other people. It should be done on your own intuition and your own understanding. Overconfident stock investors, there are a lot of stock investors where generally they think, okay, now I know what I'm doing, this is the money I'm going to make. They don't listen to anyone else. They do their own research, and they feel that they're perfect and they know exactly what they're doing. These are the people who might end up making a lot of money or end up losing a lot of money, but either ways, these are the people who will never listen to anyone else. The next type of investors, or next type of people, are anchoring investors. Now, what is the anchoring concept, or the psychology of anchoring in investment is, a particular person decides that he wants to enter this particular stock, and he decides that this stock is going to make him money. So he finds every possible reason, or he finds every possible angle or news or facts to support his concept. So he ends up getting anchored to a particular stock, and he will be in that stock even though he's making a loss. So this is called the concept of anchoring. Now, this is something which happens with a lot of people in the stock market. They consider a particular stock, they feel it's fascinating, they feel that it's good, they find all possible reasons to agree to that concept, and they get anchored to that stock. And a lot of stocks actually end up bringing that anchoring effect into your mind in the stock market. Sunk cost. Now, sunk cost is a very interesting theory in behavioral economics. The sunk cost concept means that because you have been involved, this sunk cost concept, or sunk cost psychological impact which it has, is not only in stock market, which in real life also. Now, sunk cost is a particular concept where, if I've been involved in a particular stock, a particular investment, or in a particular company for a significant period of time with profit and loss, I end up getting so sunk into it that I just don't want to exit, or I just don't know how to exit, because probably you have been so used to being into that stock for a significant period of time. Say, for example, if I bought BBTC for almost 3 years, I'm holding it, and now I'm holding it through good and through bad. Now, when I feel that probably I should sell it, I just don't want to sell it because I'll be like, I've already held it for 3 years. Why don't I hold it for more 3 years? Now, this is where a lot of people get sucked into, because they will be like, okay, I held the stock made me loss, but I've been holding it for so long. What am I losing? I'm not going to lose anything from my hand. Let me hold the stock for more longer period of time. Now, sunk cost has a very high impact on people, not only with investing in stock market, but also investing into live market, or also with natural things which happen around you. Because you end up, because you're working in a particular environment for a long period of time with good and bad in it, you end up getting so attached, or you end up getting so sunk into it, that you feel that letting go of it right now probably will not be worth it. And similarly, with a lot of other actions which we do, we probably feel like, for example, if I'm doing an education and I started my masters and or my bachelor's, and second year I realized that this is not for me. But just because I spent 1.5 years and I've done heavy amount of hard work, and I've done heavy amount of studies, and I've gone through so much to get into this college. Now, because I've done that 1.5 years of hard work, because I've gone through that 1.5 years of effort, I'll try to make sure that I remain for the next 1.5, 2 years, even though I don't want it. And after those 3 years, I'll end up doing something else which I want to do. Now, this is a sunk cost effect. This is a basic example of a sunk cost effect. You end up doing things which you do not want to because you have ended up putting enough time into it. So this is something which we need to be very careful in the stock market. Be very rational, be very detached. Don't get married to your stocks. Ostrich effect is when you have invested into a particular stock, you have been involved in that stock for a period of time, but you try to uh, avoid all the negative news which comes against that stock. Now, what does an ostrich do when he or she is in danger, when the animal is in danger? An ostrich predominantly is known to duck their heads inside the ground to avoid danger. So this is something which is called an ostrich effect in behavioral economics, where people end up digging their heads inside, or trying to avoid all news which probably could affect their positivity on a particular stock or particular investment, which is a very wrong thing to do. Because when you're considering an investment or stock, because you have made an investment, that doesn't necessarily mean you should not look at it in a critical perspective. You have to look at it in all critical perspectives. This will help you understand the stock significantly, inshallah. Fallacy of relativity, basically, fallacy of relativity is wherein how you are able to relate to a particular stock for a significant period of time. You should be able to consistently agree to all the positives and negatives. Say, for example, now I am there and three other people are there, and one person is saying that, this stock might be tricky. I mean, three people are saying this stock might be tricky, and probably we might be able to make money, we might not be able to make money, it's better we avoid. But the fourth person is like, he's made his mind, he says, no, I want to invest. Probably you're also right, I'm also right, let me invest into this. So I could have my own perception, you could have your own perception. This is a very gray area, because a lot of people might have their respective perceptions, but you have to see what is the larger analysis of a particular stock when you're into the basics of the stock market. Probably eventually, when you're becoming really good at it, when you are thorough with the basics and fundamentals, you can actually take decisions against the stock market trend. But sometimes when you're going with the mentors, or sometimes when you're going with people who can guide you, industry specialists, it's better to go with the consensus. Don't let the fallacy of relativity to affect your mindset. Stuck in the past, a lot of investors get affected by this. When they lose money, they just avoid the stock market completely. They say, this is not for me, I will not do it no matter what. Or probably if they've lost money, they'll be stuck in that mindset, I have lost money, making money is not for me. Or if a particular stock is has made money for them, they constantly keep investing in that stock even though they're losing money, hoping that one day they will make money. So stock market is something which has a lot of psychological factors involved in it, and it affects an investor in multiple ways. These are a few ways which I could pen down, probably to make you understand how the stock market will affect your psychology, and how you can actually get out of all of this, and how you should get out of all of this, and be very simple. Now imagine, in just probably 1 hour of study and research, I'm putting down approximately 10 concepts in terms of how stock market affects your psychology. Like this, there are a lot of other concepts in the market which affects your psychology. So probably you need to do things outside these 10 things to become successful. So meaning that if you do only that one fundamental thing right, all these 10 psychological factors will not affect you anymore. You'll become an investor. So this is what stock market is all about, doing basic simple things, a few things, but doing them right. Now let's come to the next concept, that is decision paralysis. This is something which happens to a lot of investors into stock market. They get when they're making a decision. There's a concept called decision paralysis, which is about a few things related to the stock market. Now that is about why people avoid taking decisions. Now, if there is a particular decision making which is happening right now, people end up avoiding taking those decisions because either they're fearful that they're going wrong, they're doing something wrong, or the possibility that they might lose money, or they don't want to look foolish, or unwillingness to take the risk. Lastly, the hypothesis of investment that has gone wrong, probably in terms of what they thought about the investment or what they thought about this particular thing which is going wrong. Is these are few factors which make a person's decision to be held in a particular format, and even though there is an opportunity, he does not take it. So this is a huge factor in stock market investing. A lot of people end up going through decision paralysis just because of these few factors, because they feel either they don't know about stock market, or they fear that whatever they're doing is wrong, or they fear that they're going to lose their money, or they don't want to look foolish just because they did not know anything, they ended up doing something and they lost their money. And some people just don't want to take the risk. So there are few things which make the right decision making to just not happen, and these are the few reasons why. How you can get over it, by deciding not to decide is also a decision. You have to understand that. So making the right decision is important. Immediately taking a decision is important. Consider the opportunity cost. Now, what is a decision paralysis related to stock market? It's not only related again to stock market. In any parts of life, if I'm particularly doing a venture, if I'm venturing into something new, or if I have a new proposal in hand, or if I have a new project in hand which is totally out of my forte, totally out of what I've done for the last 20 years or 25 years or 30 years, people don't take it because they feel either this is not for them, or there is a risk involved in it, or there are probably a couple of other things involved in it too. So it's important that you take the right decision, consider the opportunity cost, consider what is the cost of losing that opportunity, and inshallah this way you will be able to take the right decision with the right impact. Put yourself into an autopilot mode, constantly keep putting a little bit into investments. That is it's called systematic investment planning as SIPs. This way you will not feel a big pinch, you will also feel that you're constantly contributing towards development of your future. Change your frame of references. Don't constantly go with the existing references you have, go with a fresh source of references. Don't get married to your stock. It is important that you're able to disconnect from your stock. It is important that you're able to look at stocks with the rational perspective. The purpose of investing into the stock market is to maximize your gains, not to get attached or not to hold a particular stock just because you feel attached to it. Understand that there is no free lunch. There's nothing free in the stock market. If you want to make money, you have to put money. If you want to learn something, you have to put money. You have to constantly upgrade yourself. Nothing is free. If anything is coming free, of course you have to be a little careful about it. That is advice, stock market recommendations, different strategies. You have to go through something at least to gain something. Learn to apply the famous principle of worry by Dale Carnegie. That is to put a stop less on order on your worries. That is, don't constantly keep worrying. Don't give a thought more focus or more anxiety than it deserves. Just refuse to give that thought that attention. You feel if the particular thought of a particular worry deserves only this much attention, give it and stop. If you're investing in a stock market, you've made a loss. Yes, you have made a loss. What is the worst that you can think about? Think about it, stop, and then just let go of it. Give it the attention it deserves. Don't constantly keep tripping on it. Don't constantly keep thinking about it, not only in stock market but even in practical business surroundings, or even in life as well. What comes to you, what worry comes to you, look at it at that particular moment, give it its thought, give it its do justice to it, consider it, look at pros and cons, think about it, and think about the worst case scenario, accept the reality, and just move ahead. And this inshallah will help you to put a stop less order on your worries in life. And last but not the least, plan and prepare. So now probably we'll go for 15-minute question answer session, and we'll take a small break, and then we will come to the next topic, that is the stock market traps, the booming sectors in the industry, and analyzing different stocks, inshallah. Question by brother Shaul Hamid. Assalamu alaikum, brother. I'm an NRI. I have an NRI account. Will I be able to create a demat account? If so, will I be able to pay IT from NRI account for profits from the stock? Please guide. Yes, brother, you can open an NRI account, but NRI demat accounts have their own respective complications. It's not complicated, but a lot of documentation, because everything comes from foreign revenue. So this way, you can understand, you can open a demat account. There's no problems, there's no issues with that. And probably you can also the IT will also be deducted. Generally at the end of the year, you have to file the stocks you have. But since you're staying abroad for more than 6 months, probably we can speak to the auditor and see, based on what you're declaring and how much you're investing, how much you need to pay in terms of IT. That can be discussed on portfolio to portfolio basis. And what are the IT for profits have to be paid only when you're taking the profits, basically. So if you're making profits and you're taking it out in your account and getting a payout, probably for the payout which you're taking, you need to pay a particular tax based on what you're declaring at the end of the year. Do we have to pay taxes on profit? Yes, there are taxes on profit. But that is not while you're taking out the profits, but at the end of the year, what profits you're making in the stock market, that is something which will be taxed by the government. And that is up to you how you're adding your expenses and your income into the balance sheet, and how you're declaring it to the government, inshallah. Whether BTST will come in halal else position stocks for quite some time. BTST means buy today, sell tomorrow. Now, BTST can be considered halal, provided, like for example, buy BTST not necessarily means just buying today and selling tomorrow. Probably it means buying today and selling in 2 days or 3 days or 4 days. It has its range. So the idea of BTST doesn't necessarily mean that if you're buying today, you have to compulsorily sell tomorrow. You can hold for 2 days or 3 days or 4 days. Basically, it is the rally which you feel you can be a part of. It's only BTST people generally do only when they know for a fact, okay, market has fallen, now the stock will go up for at least 2%, 3%, or 5%. They enter the stock for a brief period of time to enjoy the rally of the stock market. So it is considered halal by investors, but not on a very aggressive regular terminology, like constantly BTST. That doesn't work. Probably you can do BTST couple of times in a month, but at least have wait till the time you get the delivery of the stock in your hand, which is T+1 or T+2 days. That way, inshallah, it will be beneficial for you. How new stock prices are fixed and who is deciding it? Basically, the new stock prices are fixed based on what is the value of the stock in a secondary in the primary market. Now, when I'm, say for example, I'm a private limited company, based on my revenue, based on my cash flow, based on my profitability, based on what revenues have been given to my investors previously, we will derive a valuation of the company. And that valuation of the company, once we derive it, we will try to at least increase it 30%. That is generally what happens in the market. They increase the actual value of the company 30%, and then they go IPO, that is initial public offering. They try to go into the stock market by to raise more funds, to raise more money. And once they raise that money, they to raise that particular money, they issue a particular issue price, that this stock we are going to issue at this particular price, and this many stocks only we're going to issue in the market. So who decides the price of the new stocks? It is the companies which are going public are the ones who decide the stock of the new price of the new stocks, and they are the ones who decide how much money they want to raise on the market. Without doubt, that price doesn't necessarily need to be true. It probably could be undervalued or overvalued. Sometimes what happens is the stock could be perfectly valued, but the market feels the stock is too undervalued. So immediately after the IPO, the stock shoots up 100% or 50%, 80%, and that's what happens with a lot of IPOs, or predominantly a few IPOs at least. Is there a fixed percentage of tax in stock investment? The percentage of tax is basically fluctuative based on the slab under which you come in terms of your income tax at the end of the year. So, Mr. Nalin, just for your understanding, the percentage of tax for stocks is fluctuative based on how you are investing into the market. Iron stocks, TDS, yes, stocks have their own TDS at source, and it depends upon how you're taking your payouts. So if you're probably taking regular payouts, you will see that the TDS has been deducted on a regular basis. Probably if you're taking once in a year or something like that, even though the TDS is deducted, obviously at any point of time you can claim the TDS back at the end of the financial year in your accounting sheets. How do you suggest to hold a percentage in positional short-term, long-term stocks? Do we have any such guidelines? Like you said, 100% capital divided into three categories. Yes. Now, this is something which has always worked for me. I generally, what I do, I hold stocks or I buy into stocks, not with my complete corpus, because if you understand that all over the world, any successful, I will be talking about portfolio diversification now, how to diversify your portfolio. But if you see, no person invests 100% into stock market, because stock market is the most aggressive and fluctuative way of investment. So what they do is they invest only 25 to 30% of the corpus fund. So after that 25-30%, whatever they invest either into real estate, into gold, into bonds, into other things, treasuries or something like that. This is what other investors all over the world do. But what can halal investors like us do? How can we balance our portfolio? If you're going to focus only on stock market, I will say go with 33, 33, 33. 133 portion, that is one portion, you should not use it at all. It's just going to be there. Probably once in a year you might use it when there is a situation, but that is going to be your emergency fund. So if you're investing 1 lakh rupees into the market, you want to invest 1 lakh rupees into the market, take 33,000 separately and keep it in the account. No matter what, it's usable or not usable, keep it separately. Use only the other two portions. One portion is aggressively going to be in the market, the other portion is going to be used only when the first portion is getting hit by a certain amount of loss, to average and to exit a particular stock. So this is something which worked well for me. This is something which I would suggest all of you to do. This will help you reduce your risk also. This will help you be more prepared for the fluctuating of the market as well. Do we have any more questions? Otherwise, we'll just take a 2 to 3 minute break and then we will continue with the session, inshallah. Okay, so we'll take a 2 to 3 minute break, inshallah, and we'll continue. Bismillah ar-Rahman ar-Rahim. Alhamdulillah wa salatu wa salam ala Rasulillah wa ala alihi wa sahbihi ajma'in. Amma ba'd. So let's move on to the next topic. The next topic will be in regards with what are the stock market traps, and basically how does it affect us in terms of our investing capabilities. Now, these are few things which probably I got found myself stuck into during my initial years of investing in not only the stock market, but generally this is a wave or a trend. All these things are psychological effects which generally we see from stock market but practically is used on a day-to-day lives. So something called value traps, it involves picking stocks that are trading at less than their book value or intrinsic value. In simpler terms, it is about investing in stocks that the markets are underestimating at a given time. What happens is you end up investing into a particular stock, probably because it's fallen, about probably because it's below its intrinsic value. But if there is something negative or there's some fundamental mistake in the company, you might end up investing in the stock and you might end up losing much more money. Like for example, with other stocks which have crashed, which had crashed, like for example, you had something called PC Jewelers, which was a very good stock. It was trading at around 500, 600, 700 rupees, and suddenly it started falling. And then when it started falling below 400 rupees, 300 rupees, a lot of people started investing because they felt that this company was excellent, fabulous, has been into market for a long time. But then only after they invested, they realized the stock price was falling because there was some internal problem between the founders, and they had swindled money from the company for their personal needs and finances. So this is something which comes as a value trap. We have to be very careful when you're finding companies below the intrinsic value. When you're finding companies coming under a particular range, you have to see why the companies are coming there. Is it because of a panic sentiment, or is it because of a fundamental factor? The next trap is the bull trap. That is, a bull trap is basically a false signal referring to the declining trend in a stock, and now index or other securities that reverses after a convincing rally and breaks a prior support level. A bull trap may also be referred to as a whipsaw pattern. Now, basically, what happens is when there is a declining trend and the stocks are going down, the markets are going down, a lot of people start analyzing, okay, so the market is going down now, bull trend is going to come, the bull flow is going to come. So a lot of investors, the psychology of investment in the stock market is when the market is going down, they keep waiting for the market to go up. When the market is going up, they keep waiting for the market to fall. So they constantly keep anticipating probably what could be tomorrow, what could be tomorrow. So that is what futures and options are all about. So what the stock market does, why is it so fluctuative, why does it have such a fluctuative impact on finances, is because when the markets are going down, they constantly keep gambling on markets going on top. When the markets are going on top, they constantly keep gambling on the markets going down. So whenever you are getting stuck with this bull trap or bear trap, where you feel that a market is going in a particular trend and it might change, you're already losing your focus on investments, because an actual investor does not invest into the market, but it invests into the company irrespective of the market situation. So if you feel the company is doing good, if you feel the company can grow well, if you feel the company will make value of this particular situation, you can blindly invest in those companies. Now, dead cat bounce. Now, this is more relevant, according to me, when it comes to the stock market traps, because this is something which a lot of people get stuck with, and I personally make benefit out of it, because that is, few people have their strengths, and probably I am good at figuring out a dead cat bounce. So, what is a dead cat bounce? It happens when a particular stock is going up, and I mean, it's in a very good price, and suddenly, due to a panic situation, the stock falls. Not only a panic situation, suddenly now US market something happens in US suddenly talks to China and says that we are going to have a trade war with you. The US market collapses. Because of the US market collapsing, all the markets in the world collapse because they interlinked. Because of that effect, the market in India also will fall. Now suddenly Indian market will fall for 3 days for no reason, because US has done something crazy. Now what happens is during this time, the market is bleeding so badly, the stocks are bleeding so badly, so the stocks keep falling and falling. Now this is where the dead cat bounce comes into play. So when the stock falls, you have to understand the psychology. The stock will never fall at one shot. It will never be like a falling knife. It will go down, it will come on top, then again it will go down, again it will come on top. So what happens is the time when it goes down and then it comes on top, that range is called a dead cat bounce. Now that's when that a cat, before it dies, it gives one last bounce. That's exactly what the whole theory comes behind. So it is called a dead cat bounce. So this dead cat bounce was not generally useful for me only in stock market, but it was very useful for me when it comes to understanding any market trend in any industry, because we realize that there's no industry which falls and falls and falls. It falls, it little bit recovers, again it falls, it falls, it recovers, and again it falls. So at any fall in the stock market, you will see there'll be a brief recovery. Like for example, if I'm investing in silver or gold, not obviously in the online market, but in the offline market. Now, I had a particular position of a product, and I see that suddenly the prices of silver fell from 68,000 rupees per kg to around 58,000 rupees per kg in the span of 2 days or 3 days. Now, when I realized that that fall is approximately around 20%, now this is where our fundamentals come into play. Now, this is not only for stock market. So I realized, okay, there should be a dead cat bounce, because there's no market which will fall like a falling knife. So there will be a dead cat bounce. Probably the uh, rate could come from 58,000 to 62, 63,000, because the dead cat bounce generally ranges. Say if your stock is falling 10%, there will be at least a backtrack of 3 to 4%, and then only it will come back again below the 10% category. So that's where we try to invest and try to see how we can get a return. So if we have a good stock, we have two options. So let me just complete the story. So when I saw something like this happening 2 3 days back, I decided that I'll invest something on a physical format so that we can invest and we can keep for a brief period of time. And then when we saw the prices were rising, like for example today the price of silver is around 63, yesterday closing price was 63, we felt that we made a significant margin, and we decided we will sell it in 3 days, in terms of after getting the possession of the good. So these are some fundamental rules generally which will be used for other things as well. So we use dead cat bounce for other things also, and we felt that it was more beneficial. Now this is something which might be beneficial for you. So whenever you see there is a good stock, there is a market falling for no reason, or just because of something which is happening abroad in different countries, wait for the right opportunity. If it's going below its intrinsic value, invest there. From here you have two options. You can either hold for 4 5 days and wait for that to go on top, and then probably then the rally comes back again. If it's going down, then you can sell it in that 4 days after you get the delivery of the product. Or you can wait and hold, because you're anyways getting a good price, so you can keep buying every time it's going down, and the average price will be much lesser. And immediately when the stock starts getting into a positive trend, you will see you're making better returns in a in a much larger corpus of shares which you have, inshallah. Now we're speaking about stocks, but what is the industries which generally we should focus upon right now in considering the market trend and seeing how the things are changing? What is going to be the future of the market? What are the different sectors we have to focus into? This is something which I decided I will add only yesterday night. So we have done just a basic research in regards with what is going to be the future and what will be adding significant safety, excuse me, in terms of investments and returns. There's one industry which I forgot to mention in this. It is or not industry, but rather a security, is investing into physical formats of gold and silver is a very strong way to keep your money safe and keep your money liquid. Now it is important that obviously a lot of people cannot invest significantly a lot, but you have to understand that gold and silver are the fundamentals of market uh, safety, not safety, but market running. The market runs on these fundamentals. Now, if you understand what is currency or what is cash depending upon, gold reserves of the economy, what are any economic factors dependent upon the commodity reserves of the country. So you have to understand there was a time where there was barter system, but now it is cash. So the cash is backed against the reserves which they have. Now, predominantly, when these reserves reduce, the value of the cash reduces. When these reserves increase, the value of the cash increases. So this is how the currency develops strength all over the world. Now, what could be done is you have to understand at any point of time, investing your portfolio in these formats also will add significant value to you. But other than these things, what are the other industries which will add value to you will be the new trend which is coming in terms of e-automobile, because pollution is becoming a risk. A lot of vehicles and vehicle making companies are translating themselves into electronic vehicles, into electronic gadgets, into electronic batteries, into long lasting batteries, gigabyte batteries. So if you see the reason why Tesla in the last 3 months has grown multi-folds. Elon Musk came from a $30 billion net value. Right now he's trading I probably at around 95 billion net value in the span of 3 months. He himself in Twitter posted 3 months back. He said that I find the value of my company to be stupid. I feel that you people are overvaluing my company for no reason. The stock market fell for like his stock price fell for 8%, and immediately people started buying, and then the stock started multiplying approximately around 70-80% in the span of 3 months. So why is the trend positive? Because they know that now things will change from minerals and fossil fuel to more of electronic and gadget related things. So new technologies on battery creations, new technologies on vehicle creations, how to convert things into the e-concept, that is going to be the future. And the next thing will be consumer durables, which is always going to be a moving industry, because these are things which people consume on a day-to-day basis, and this is something which will survive inshallah no matter what in the next forthcoming years. So the third industry probably you can focus on is IT, AI, robotics, information technology, artificial intelligence, robotics. Probably you can add IoT to it, Internet of Things. Then you can add data analytics, you can add cloud computing, and you can also add augmented reality, virtual reality, and many other latest technologies, blockchain technology. These are going to be the future, because this is something which the world probably I feel could depend on in the next 10 to 15 years, or probably which should be the new gold mine. That is exactly why companies like Reliance or Facebook or Google or Apple or Microsoft are constantly growing in terms of stock value, share value, and in terms of revenue also, because they are focusing on the next 10-15 years, which is going to be artificial intelligence, which is going to be 5G technology, which is going to be IoT, which is going to be a lot of technical factors. And this is exactly what we believe in Zaria also, that this is going to be the future. And inshallah, we have to somehow create an opportunity where we can focus on these industries as well. So this is something which we feel that could be the next gold mine of the coming generation, or could be the new oil of the current generation. Data is everything now. So that comes into IT and AI and robotics category. Pharma, biotech, genetics. This is something which has you see has been growing significantly in any crisis situation. During the COVID situation, after the COVID situation, the vaccine has still not been launched. So investing into pharma companies, because people are still panicking whenever they get a cold or something, and there's a lot of what do you say, a change in mindset when it comes to health related issues. So pharma, biotech, genetics, and alternative medicine also is an industry which has been significantly growing, and this is something which probably you can see will add more value in the future. Infrastructure and logistics. Infrastructure always has its dependence, always has its growth factor, because any economy to grow needs good infrastructure. Any economy to grow needs a good real estate value. So infrastructure always has its own safety as well. It is not very risky, or you always have an underlying asset. So infrastructure is an industry which probably you can focus on, but you have to see it's a tricky industry also, because a lot of infrastructure companies are significantly drowning in debt. So you have to see companies which are going to be more debt free. Probably you can invest into infrastructure industry, but on the REIT model, REIT, that is real estate investment trusts. You can focus on the real estate investment trusts which are listed in the stock market, and probably that will give you some sort of a safer return, inshallah. But all these industries which I'm talking to you about is just a future trend analysis, which probably could add value. Logistics, any company to run needs a good logistic team, and logistics always has its own strength, and it's something which is basic in any business. So that is something which always grows and always has a good return. Now let's come to some basic understanding, because a lot of people yesterday were talking about give us some recommendations or something in regards with what stock market is all about, some fair idea. Now these are not recommendations, but this is something which is a list of stocks in the Sharia index. So if you see, there probably might be around 50 stocks here, and in this 50 stocks, that is the Sharia 50 index, all of them are good companies and are considered to be Sharia compliant right now by the list of scholars approved by TASIS. how we can go through these companies, how you can analyze these companies. Currently, if you see Ambuja Cements, Bharti Airtel probably has debt, but it has under the debt category of 5 to 10%. Right now, especially after the clearance of their debts with the Supreme Court, they come under Sharia compliance, is what I feel. Then Dr. Reddy's, you can see Cummins India, Cipla, Biocon, all of these are good companies. Reliance, you can see inside. MRF, excellent stock. Maruti Suzuki, Siemens, all of these are some strong stocks which have been there. Tech Mahindra into the stock market in the last couple of years, and they have been doing very well. So these are just a few brief outline. You have 50 companies probably to study, research, go through, and see how to invest in these companies. Where can you find an opportunity? Most important factor, try to see how you can get the momentum in place, try to see how you can feel the stock and how you can understand the stock. ONGC, I would like to ask you to avoid it from this particular portfolio. ONGC, even though is a say a company which has been backed by the government for oil and gas, but I personally do not consider it to be into the heavy Sharia compliant norms. It has its own fluctuativity, it has its own risk as well. So I would suggest that people be a little careful with ONGC. Then probably other than that, BHEL, a little careful again. Even though the stock is safe, has very simple growth patterns, but it's better you do not get stuck with BHEL. Okay, so now what we will do is in the next slide, we will be discussing about how you can fundamentally and technically analyze a company to see whether it's Sharia compliant or not, and to analyze what is the debt equity ratio. Because yesterday I had a couple of people asking me, what is the debt equity ratio? How can you go through it, and what you have to do to see whether a company is Sharia compliant or not. Generally, when you go through any stock, let me show you here. Let's go to our practical sessions now a little bit. Now you go to money. Can you see the? Can you see my screen? Moderator, can you see my screen?
Yes, I can see.
Okay, great. So then first thing we do is we go to one of the websites which we use, that is Money Control. And when we see Money Control, you go here, and this is one of the very basic stock market studying portals which we have, which is very good, and it's quite elaborate, and I've been using it for quite some time. So you can go here and say, for example, there is a company which we showed in our PPT, that is say MRF. So now you have to understand what is ROA, what is ROE, and what is ROCE. ROA basically is return on asset, ROE is return on equity, ROCE is return on capital expenditure. So now you have to see how the company has been giving returns on its assets, on its equity, on its capital expenditure, and then you can analyze what is the profitability, liquidity, valuation, and what is the ratio of debt in the company. Now, if you have to go through a particular company, say we're going for MRF, so we search MRF in the list. Then when we see a particular stock, you're obviously going through. Now I'll be just trying to give you a practical demo on how we're going to look forward for a stock. Now this is a stock. The first thing we see is, okay, it is live on NSE and BSE. Probably what is today's high and what is today's low. So the stock market has not yet opened. So probably if the stock market opens between 9:15 and then that's the pre-market closes. So from 9:15 you can see the stock market going live. So when the stock market starts from 9:30, it's up till 3:30. So first things you see, what is today's high, what is today's low, then what is the 52-week high, 52-week low, and then you can see what is the volumes in which the stock is trading. So the volume is only 469 in BSE and 17,381 in NSE, which is a good sign, because it means not a lot of people want to buy and sell the stock. People are more confident on holding the stocks. The stocks with bigger values are stocks which people like to hold because they know they're going to get a better return out of it. So once you see these basic fundamentals, then we try to see what is the strength, opportunity, weakness, opportunity, and threats of the particular stock. So this is something which is as a new option which has come in Money Control. So you can see whether what are the strengths in the company. You can go through, you will see that the strengths of the company is with low debt. The company has zero promoter pledge. None of the promoters have pledged their stock in the stock market. So this means that there is a particular understanding on regards with what is the pledge. Can you go through?
You're not doing the money control.
Yeah, this is money control.
No,
One
it's
second.
not being shared on the
Okay, 1 second.
screen. But it's just
Can you see my screen?
those no. Oh yeah.
Can you see my screen now? Yes, absolutely. Okay, absolutely. Sorry. So let's go back again now from the start. Okay. So when you see a particular stock, you go to this website called moneycontrol.com, and there are a couple of other websites, like I will mention that also, screener.in. Okay, so you have screener.in, which is also a good tool to understand a stock. Then probably you can go to live mint for news, which is good for news in India, and then investing.com. So I'm going to type a few companies and to a few portals and keep. So this is something which, as a stock market investor, you should be able to access on a regular basis. Investing.com, important. It's important because it gives you news about everything all over the world. Like for example, you can see different indexes in US. Basically, these are things which control other markets, such as S&P 500, Nasdaq. Probably you will not have an idea about these if you're a basic investor. These are just for your idea that what are the newses which are coming, and what are the stocks which are growing internationally, and what is happening in different formats in different parts of the world. So this is just for you to have a world picture about what's happening, so that you are not blank about what probably can affect the Indian market in the future. Let's go to what a topic has been. So say for example, you're going to see a stock, and as we mentioned in our PPT, the stock has been MRF, and for MRF we want to just go through. So we first see what is the day's low, what is the day's high. Then we see what is the 52-week high and what is the 52-week low. So the stock right now is close to its 52-week high range, because the stock has gone up to 73,500 in this year itself, and now it's around 59,000, which means that it has a potential of another 13,500 rupees. So it means it's somewhere between lower mid range. So it is something which probably you should consider, and you can understand that okay, probably it's a good concept. Then you have to see the volumes. I would suggest you don't invest in BSE, you invest in NSE, because NSE always has high buyers and high sellers. So BSE has been an old stock market, but it's better you can focus on NSE. So volumes are 17,381, which shows that not a lot of people are willing to sell the product, and there is a rotation in terms of volume. Now there is a new analysis which has come in Money Control, that is SWOT analysis, and in this you can see, if you go to the strength, weakness, and opportunity and threat, the strength of the company is with low debt. So the company has practically very less debt, and there's no promoter pledge in the company. This is very important factor to consider. It means if I'm the owner of MRF, and I've been owning this company for more than 50, 70 years, MRF is a very old company, and none of the owners of the company, none of the shareholders of the company have pledged their personal shares in the bank. So it means the company is also low debt, and the promoters of the company also are not taking debt from on the personal basis. So it shows the amount of financial strength the promoters also have. Because if the promoters are pledging their own stock, it means at any point of time, if they are ridden by debt, the company will get affected immediately. So this is something which is a very good understanding. Then you can go through, you can see FIIs and FPIs, or institutions increasing their shareholding. FIIs means foreign institutional investors. FPIs, particularly, I'm not sure about the abbreviation, but FIIs and FPIs come under the same category. And institutions are increasing their shareholding. It means large institutions which pump in heavy money, international institutions, mutual funds institutions, insurance companies, a lot of companies are investing in the stock, and foreign institutional investors are investing in the stock. It means it has a very strong foundation. That is no pledge of shares by the promoters. FIIs and FPIs have invested, that is institutional investors have been investing. A company is with very low debt, so it has strong fundamentals. Next, we'll see what is the weakness of the company currently. Declining in net profit with falling profit margins. So currently the company has been, the margins have been falling on quarter to quarter basis. QOQ means quarter to quarter basis. So you can see that the company's profit has fallen in this particular quarter. It means that because of the lockdown in the last quarter, the company's profits have fallen, and this is something which is fair because a lot of companies' margins have fallen. No one is buying tires during lockdown when you're sitting at home. So you can understand that on quarter to quarter basis, the margins have fallen. Now, what is quarter to quarter? Quarter to quarter doesn't necessarily mean from the previous quarter to this quarter. That is, say, for example, a year is segmented into 3 months each, so 4 quarters totally. So the financial year starts from April and ends in March. So this is how it is. I hope all of you know this, right? So the financial year starts from April and ends in March. Let me check. If you have any questions, you can keep asking while I'm doing the live session. So I mean, basic questions in regard with the live session, so I can interact and I can tell you on case to case basis. So quarter on quarter, Q on Q, a lot of people consider it to be from the first quarter, from the second quarter to the third quarter, but that's not how it is. From the quarter of this year compared to the quarter of the previous year. So how the stock markets analyze quarter to quarter revenue is, say the first quarter is between April, May, June. The second quarter is July, August, September. The third quarter is October, November, December, and the fourth quarter is January, February, March. It's called JFM. Okay, because the last quarter is the quarter where a lot of fluctuativity happens and a lot of closures happen at the end of the year. So right now we are at the third quarter, because this is probably no, we are in the second quarter, September 30th. From tomorrow the third quarter will start. Okay, so today we are in the second quarter. So when you're looking at companies, you need to compare the company's second quarter in 2020 against the company's second quarter in 2019. I will repeat, whenever you are analyzing a company's the quarter revenues, you do not calculate it between the first quarter and second quarter of the current year. You calculate it between the current quarter and the current quarter of the previous year. So Q2 of 2019 versus Q2 of 2020, because a lot of people end up doing the mistake saying that from the first quarter to the second quarter the revenues are higher, but that's not the case, because every company has a season. So you have to see in 2019 in the second quarter how they fared, and in 2020 in the second quarter how they fared. So that is what they mean by profit margins falling in quarter on quarter basis. Second thing, it says decline in quarterly net profit with falling profit margins, again on a yearly basis, year-on-year basis. Degrowth in quarterly revenue and profit in recent results. Declining revenue every quarter for the past 2 quarters. That is obviously because of lockdown. And yet again, this also means because of the lockdown. Fall in quarterly revenue and net profits on year-on-year basis. Yes, without doubt, if 2 quarters the company has not worked, it means it will get affected on a yearly basis. Declining operating profit margins and net profits. If the revenue is affected, the operating margins and the profitability of the company will be affected. So this is understood. Hanging man, a bearish reversal. So they feel that there is a negative trend in the stock which can start after these results have been declared. So any company will declare these results on a quarterly to quarterly basis. So based on these results, the app suggests that it's a hanging man bearish reversal. So probably there could be a negative trend in the stock. And then you can see there is an opportunity. Some insiders in the company have bought the stock. So it means that they are hoping that some positive news will come, because the people who are working in the company are buying the stock. It means there's some hidden news available inside. What is a threat? Degrowth in revenue, profits, and operating profit margin in results, which is a threat according to them. Increasing trend in non-core income. That is, they have started to get more revenue out of things other than tires. So the company has diversified its portfolio, and the main revenue is not coming from tires, but it's coming from something else. So it is a non-core income which is increasing right now, and insider stocks have been sold also. It means some people inside the company have sold the stock. It means there is some reason why the people who are working in the company have sold the stock. So you have to consider this also. So these are some overall things I've seen. So probably I have an idea. Okay, the company's 2 quarters are down, and the company is getting revenue from non-core income. People are buying as well as selling. 2 quarters are not good, so the yearly profits will also drop. So probably for the next 1 year, this stock might not be able to give me the return it has given me last year. So I have a fair bit of understanding. And then what I do, if I want to understand a particular company, I go into the annual reports. So in this annual reports, you can go through, say 2019, 2017, 2016. You have tax total income. This is obviously in crores. It is mentioned here, rupees in crores. So they have done 16,252 54 crores in terms of total income. What is the profit before tax? 1,609 crores. What is the profit provision for tax? They have paid 512 crores as taxation alone. And what is the profit for year? 1,097 crores. So the company has made 1,097 crores in comparison to 1,092 crores in the previous year, previous financial year. So you are comparing the results, you are seeing what it is, you're going to go through what are the different types of dividends which the company has given, and then you have to go through the reports to see what exactly is the revenue. Now, so for example, can you see the slide now? Can you see my slide?
No, we are not able to see the slide.
Okay, one second. New share again. Let me give you the slide. Okay. Can you see the slide now?
Yeah, we can see the slide.
Okay. So now, after seeing those factors, then you come, when you go inside the balance sheets of the company, you have to see what is the return on annual basis, what is the return asset basis, return on equity basis, return on capital expenditure basis. With these percentages, you will also be able to see what is the debt of the company. So there will be a place where it says debt on the company, interest paid, what are the money they had to shell out the last year in terms of liabilities, and at the end of the what do you say, balance sheet, you will see what is the exact value they paid in debt, what is the exact value they paid in interest, what is the exact value they made, and if you minus that, probably you will find out the percentage exactly how much has been the percentage of debt in the company, and that is the ratio which is called as total debt on to total equity ratio. So that is the debt equity ratio is what you have to calculate. Based on this, you can consider the stock to be Sharia compliant or not. So the stocks currently is under 0.2%, 0.2%, 0.2%, and 0.3% for the last 4 years in terms of debt exposure. So it comes under a Sharia compliant norm. And this is something which you can understand with a lot of different stocks. Probably I will do another stock for your understanding. You can go through a company called Biocon. Biocon is a company which has been showing return on assets on 5.18% per annum. Return on equity has been 11.15%. Return on capital expenditure. What is capital expenditure? What is equity? Equity is on share. For every person who has held the share, the return on equity has been 11.15% per annum. They have made money. Return on asset, on every asset the company has been owning, they have been making 5.18%. So if my company is owning a property, I'm making 5.18% per annum out of that property. If the investors who are investing in my company, they're holding equity, so they are making 11.15% out of the shares they're holding in my company. Return on capital expenditure, as a company, what I'm investing into the market to grow my business, on what I have invested in the market, I have gained 11.61% at the end of the year. This is what this analysis means. So now let's go to the session, to a practical session demonstration again, and see probably what can it add also. One second. Yeah, can you see this now? Yeah, can you see this screen share? I think probably yes, you can. Okay.
Money control.
Yeah. Great. So Biocon, I'm going to type based on the PPT which we discussed last. Yes, the multiple year analysis you can see in money control. What is the debt equity ratio which is not Sharia compliant? The scholars globally have agreed. I have to be very honest with you, but I'll also be a little strict in terms of my suggestion. The scholars have agreed up to 25% from IOFE and IFSB, that is international standards. But I personally suggest to go with debt-free companies or companies between the ratio of 5 to 10%, because this is where fitna comes into play. People say, okay, 25% is allowed, so they start with 25, they end up going to 33, and from 33 they end up going to companies with completely in debt. So it's important we have our principles in place. Let's go with companies with very low debt that will give you a very strong and solid return, inshallah. So answering your question, is this multiple year analysis available in money control? Yes, it is available in money control. Like for example, right now the time is 9:07, and you can see that the session says pre-opening session prices. So before the stock market is opening, you can see that there is a certain set of people who are trying to buy and sell, who are predicting the value of the stock in the future. And this way, you can understand, okay, this particular stock, the value has been 449 and 462. That was yesterday's high and low. And sorry, this is today's only, but this is pre-market high and low. That is, the market hasn't opened yet, but people within the stock market have a session called pre-market, which is a advanced topic. Probably we can talk about that later. That will not affect your basic understanding about the stock market. You have to see whether the stock is in high range or low range. The 52-week high has been 217. The 52-week low has been 217. The 52-week high has been 463. So right now the stock has been trading at 455. It means it is on all-time high, and it could be either overpriced or it could be something where the stock might be beating the estimates and can grow from here another 50 or 100 rupees also. To understand that, we have to go through the different trends. Like for example, probably you can go to the charts. You can see, as I discussed, the stock started with 250 rupees this year, then it fell to a particular point again after growing. That is in February 2020, that is before lockdown. Then after lockdown till March 19, it fell down, and from here the stock has been rising completely. So now the stock has actually breached the 200-day moving average here. So this is a 200-day moving average probably of the stock, and it has breached it here, and you can see down the volumes in terms. So whenever these bars are spiking, it means that the people buying the stock is extremely high. So whenever you see that this candles down, the bars are spiking, you will see the stock price has significantly risen. So see from here, this stock price has shot. So the bar was very small here. If you can see, the bar has been very small here, and from if you can go down, you can see the bar has been small, then it's increasing, then increasing, then increasing, and then increasing. So the more the volumes have been increasing, the more the stock has been going up. Then again, this volumes have been a little higher here, then the volumes have been high. That's the reason the stock has fallen significantly. So it means a lot of people sold the stock. So when the volumes are high, doesn't mean the stock will compulsory go up. It means the stock will go down also. So when the volumes are high, it means the stock can either go significantly up or it will go significantly down. Now from here you can see the stock again has risen up, and when the volume is again high, it is breached the previous low. If you compare it from here, see, you can see it's 350 for 345 here, and again it's somewhere around 350 range. So you can see it has breached the 345 range, and once it breached, it's constantly rising till 437. Again it's constantly rising, and now you can see that there is a significant increase in volume in the last couple of days. Hopefully, I feel that the stock can go up to 480 or 500 rupees probably in the next couple of days. I mean, probably it could go. Understanding the way the company has grown in terms of graph, the company has can have a very strong level. So you can see different support systems. These are some advanced things. You can go through what is the market cap. The company is valued at 54,702 crores. The profit per equity ratio is 132 rupees per equity stock. So this is something which the shareholders have got this year, approximately 32 rupee per stock. If you see 250, that is around 220. If you start with, add 130, you can talk about somewhere around 350. So on average, they're coming to a return of 350, I mean 120, 130 rupees per stock you have got this year. This is what they're adding in terms of the profit equity ratio. Dividends have been 10% in terms of the stock value. Market lots or industry returns, that is profit to equity return, industry wise they're given 36%, 36 rupees, sorry, per stock in terms of the comparison of the industry on an average. So for this company in the complete industry, if you can see it on an average is given a return of 36 rupees per stock. Now let's also understand what are the dividend yield percentage, face value. This is something which probably you can see later. Here you can see the simple moving averages. You can see when the stock breached the 200-day moving average, 351. Okay, what happened, which we discussed yesterday. What is the most important factor for a stock to rise, or what is an important factor for a particular stock price to go up? You can see when they breach 351. As I told you, when I was discussing with you, I told you probably this will be the 200-day moving average. So this was the 200-day moving average. So when the stock breached 351, the next thing that stock has done is it's reached 455 in a time frame of probably couple of months. So this is something which you have to understand, that the 200-day moving average, what indicator it plays. So you have seen here when the stock breached its 200-day moving average, where the stock has gone, and probably these moving averages is something for short-term investors. We have to focus on long-term investors. As one brother expected, whether we'll get the say for example weekly or a comparative study, you will get it here. If you see consolidated, you can go here, and then probably you can start seeing the corporate financial actions, that is the annual reports. If you see these annual reports, you can see here, this is how the reports come. So the financial year 19, this has been the total revenue financial compared to financial year 18. So the company has grown 25,502 crores, from 25,502 crores to 30,000 crores. So that's approximately around 20% growth in terms of the revenue in the financial year from 18 to 19. Okay, and you can see this in terms of comparison, in terms of consolidated results. Standalone results is that for that particular year in terms of that particular value. So if you see, the expenses here has been 26,488 crores for the company, and this is in my understanding, this is for that particular quarter alone. Yes, sorry, this is for that particular quarter alone. If you can see, this is the consolidated results for the whole year. So the whole year, the company has made 56,588 crores in terms of value, and that particular quarter, the company has made 30,022 crores in terms of value. And this is the expenses for that quarter. This is the expenses for the whole year. The company has made a profit before tax in that particular quarter of 3,584 crores. In that whole year of financial year 19, it's made 10,203 crores. So similarly, if you see the profit before tax, the income tax which they have paid, non-controlling interest, so there's nothing in terms of debt which they currently have which is controlling their interest payable. Profit for the year is this. Other comprehensive incomes 131, total comprehensive income is this. Earning per share is 8.33%. So there is no exposure to debt by the company in the last couple of years. That is from financial year 18, the company has not been exposing itself to debt. So it's a strong fundamental company, and this is how you particularly analyze a company to see, okay, the company is strong, the company is making good revenue. Yearly, it's making this much revenue. Quarter to quarter basis, you can see from financial year 18, in the final quarter, it has made 25,000 crores. Here it's made 30,000 crores. So 20% increase quarter to quarter basis. Expenses have increased, yes. Profit before tax also has increased. That is 500 crores has increased. Then you can see profit before tax has also increased. It's increased to 5,521 crores from 3,058 crores. Now, if you can see, the profit has increased significantly, even though the income hasn't increased that much. So it is almost doubled in terms of profitability. This is a sign of a successful company. This is a sign of a strong company fundamentally. So the company has also reduced its income tax payable. It means they have increased their expenses to reduce their income tax payable. So you can understand the relationship here. Then you can see the company has made a profit for the year of 4,927 crores against 2,385 crores in the previous quarter. So you can understand the company has made again 100% increase from this year to this year. Other expenses have also grown from 65 to 135. There's again 100% increase. Total comprehensive income has increased from 2,320 crores to 5,058 crores. And similarly, earning per share has also increased from 4.04% to 8.33%. And if you compare the whole year, from 6.33% to 15.30%, that means the company has grown more than 1.5 times from financial year 18 to financial year 19. That is, if the company has been making 1 lakh rupee revenue in the financial year 18, the company has been making 2.5 lakh rupees in terms of overall revenue. Now, till here, let me see if I can see any questions. Multiple year analysis, yes, you can see into you have every option in money control. You can see multiple year analysis, you can see comparative results, you can see the shareholding pattern, who are the shareholders in the company, what are their holdings in the respective company. You can see the shareholding patterns here. Probably, let me see. Okay. So when you go into the shareholding, probably, yeah, here it is. So what are the shareholders of the company? You can see the shareholding pattern. The owners of the company are holding 60%. Foreign institutions, that is big investors, are holding approximately 15%. And domestic institutional investors, DII, are holding around 12.33%. Financial institutions are holding 1.62%. Mutual funds are holding 5.13%. And other DIIs are holding 5.58%. So total is 100%. These are the shareholdings of the company respectively each year. So if you see, it is a very elaborate session in terms of what is the shareholding, what is pledged. Nothing is pledged. Nothing is pledged. So company is absolutely free of financial stress. Okay, what are the companies? What are the shareholders? 60% of the company is owned by shareholders. It means the promoters believe in the company. They don't want to sell the company. They feel the company will grow and they feel there is more value to the company. What is the peer comparison in terms of what other companies are there in the industry? Biocon is a medical company. Biocon is a pharmaceutical company, and compared to their market competitors, Sun Pharma, Piramal, Vivo Biotech, ANG Life Science, you can see that this is the comparative study, the last price which they have, the percentage change, the 52-week high, the 52-week low, the market cap, the sales per quarter, and net profit per quarter. So you can see how elaborate it is. It gives you almost everything in terms of your analysis, of your understanding on how to actually find the value of a particular stock in the market. What is the market cap? What is the price? We'll go here again. Let's see. What is the price of the stock in terms of high, low, compared to the market peers? Then again, you can go through what is the net sales, net profit, total assets, price performance. So you can compare the company with the other companies in the industry in net profit, in net sales, in total assets, price performance, everything. So this is something which will give you an elaborate idea about what are the shareholders of the company and what are the results. See, you can go through the quarterly results, audited results, dividends of the company, what are the bonuses the company has given, what is the splitting on stock which has happened, what are the AGM is annual general meeting, what are the declarations which have happened by the directors in the general meeting. So probably you have a clear perspective on how to analyze a stock in terms of entering a particular stock. Before entering a particular stock, what is the balance sheet, what is the cash flow of the company, what are the ratios. You have a fair bit of understanding before you entering a company to do your research here in this particular platform. Now let me tell you, say for example, we are coming back to our slide. We are supposed to see the technicals of the company. We are able to understand what are the technical analysis available. You can see the comparative chart. This is the 1 year ratio. You can go to the 2-year ratio. In the last 2 years, the company now is on a all-time high in the last 2 years. So it means it's going on a roll. So last 5 years, again, if you compare, the company has crossed the last 5-year high also. It means the company is in the most highest format. If you go in all, you will see the company is in an all-time high. So it means this is the highest the stock has been in the last 15 years, probably from 2004, from the time the company has started. So in the last 16 years, the company is in an all-time high. So either you have to be extremely careful, or it means the company has been in extremely good pricing. Say the reason why the company is going up, Biocon shares jumped 5% on launch of diabetic drugs in US. So they have launched some diabetic drug. That's the reason the company has gone up. And then probably the charts which you were mentioning in the session, what are the different types of charts? What can you see? Here you can see indicators, you can see different chart formats, moving averages. Then you can see different indicators. What is the different types of indicators available? All these are advanced level things. You can go through, say for example, crosshair or probably candlestick, which I taught you. So if you see candlestick, you can understand when the volumes have been high, when the volumes have been low. You can calculate this here. So this is something which probably you might, only if you do for a couple of months. For basic investors, you'll have an idea how to analyze a stock, how to go through its charts, how to go through its fundamentals, how to go through its debt, assets, everything. So this is something probably when you go aggressively, before going to the market, you have to go through this aggressively. To study this itself probably will take you a couple of weeks. So it is important before you enter in a particular stock, you have a clear bit of understanding. Like for example, you see the stock price rose here, and you can see that there is a fair bit of growth in terms of volume as well. Now, if you see that the stock market has opened, pre-market has closed, and now probably the stock market would have, let me see. No, 9:30. Yes, 9:30 is where it's going to start. So probably you can see the aggressive fluctuativeness happening. Now you can see in the morning when we saw the volumes are very less. Now if you see the volumes are 2,86,614. It means 2,86,614 people are already waiting to buy or sell the stock in the next couple of hours. So this is something which helps you understand a stock in the fundamental perspective. So money control is a good option. Then probably screen sharer. If you can go to screen sharer, you can just go through Biocon Limited. Sorry, not screen sharer, screener. You can go through screener. You can see it's a simplified version. What is return on capital expenditure? What is return on equity? What is the sales growth in 3 years? 17.84%. Dividend yield has been 0.11 percentage. 52-week high, 52-week low, and what is the profit equity ratio? 71.68 rupees per share. Sorry, 71.68 percentage per share. So you can see the graph here, probably 1 year, 3 years, 5 years. This is also something you can see the analysis, peers, quarters, profit and loss, balance sheet, cash flows, ratios, investors, and what are the other documents the companies have provided in the last couple of years. What are the pros? What are the cons? Probably the con stock is trading at 8.15 times its book value. It means the company has been bought by a lot of people. A lot of people feel the company will grow more also. The company has low return on equity. The company might be capitalizing the interest cost. Basically, the company, since the company has been growing significantly, whatever interest cost they are bearing, they're trying to capitalize it by paying it off. The dividend payout has been low at 7.58% of profits over the last 3 years. And this is a comparative study with the industry peers. What has happened? What is the percentage in terms of dividend yield, in terms of quarterly profits, quarterly results? What are the standalone quarterly results from September 2018, September 2017, December 17, March 18, June 18, September 18, December 18? So you can see in the last 3 years how the company has grown on quarter to quarter basis. This is something which will give you a fair bit of understanding on how you are supposed to understand the growth of the company, how you're supposed to understand what are the operating profits of the company. The company has increased its operating profits from 182 rupees per share to 410 rupees per share in, so 182 crore rupees to 410 crore rupees in terms of its operating profit per quarter, for a revenue of 1600 for a sales of 1671. So the company has at least made approximately around 25% in terms of revenue or profits during every quarter. Yeah, so you can see this 25% for 410 crores is 25% of 1671 crores. Then other income, what is the interest? They have been paying 12 crores. What is the depreciation? What is the profit before tax? What is the tax percentage? 33% slab. They're coming under. Net profit has been 149 crores. And this is something EPS earning per share 1.26 crores. So this is something which you can understand in terms of what are the debts, what are the profits and loss, what is the depreciation of assets, what are the dividends they have paid out, and what are the other incomes, how much interest they have been paying in the last 1 year. It's a consolidated statement for the whole year. How much the sales have grown in the last 10 years? 10.44%. How much the profit has grown in the last 10 years? 10.25%. So what has been the growth return, average growth return, corporate average growth return has been in 10 years 22.26%. The company has been giving a return in terms of growth as well. Return on equity has been 13.44%. So if you have held this stock for 10 years, probably you would have been getting an average return per year on 13.44% of appreciation every year in regards of you holding the equity. Now, if you see the balance sheet, what is the share capital they have, what is the borrowings they have, and what is the other liabilities they have, and what is the fixed assets, what are the investments they have made, what are the other assets. So they have a borrowing in 2009, they had a borrowing of 524 crores. Now they have a borrowing of 2,708 crores. And you can see in terms of reserves what they have, in terms of other liabilities what is there, and this is the overall total expenses and other returns which they've been getting in the market in terms of March 2020 alone. So this is something which probably will help you understand different formats of the companies. And currently now we'll go back to our slide. So I think we have given you a fair bit of understanding. If this anyone has any doubts, please let me know. So we have another 1 hour of a session. Probably we will brief a little bit about a few things here and there, and then we will try to wind it up. So you can let me know if you have any doubts on the session till here, and I will answer these questions for you at the moment. Data, is it reliable? Who is screening? For these data for these companies are basically provided by the company themselves, number one. Number two, you have data management companies which generally earn huge value of money per year just to screen the companies in the stock market. So these data management companies are companies like people like who are doubting the data. What these data management companies do for big fund houses like mutual funds, for investment companies, for big people who are putting heavy amount of money inside, they work on a private level, and they've actually verified the data and see whether the company has actually been making significant return or not. So the data generally in these platforms is used on a regular basis by big investors, and they pay for this data so that they can make big investments in the market in the future. So there are high chances that the reliability of data is at least 90% accurate. 80 to 90%. The rest, Allah knows best, and it depends upon what is going back and forth. But in my particular experience, what I have been using this for the last 10 years, it has been it has been quite accurate in terms of its data, in terms of its data, in terms of its understanding of the market. Any other questions anyone has? Okay. So probably here we'll take a 5-minute break, and then we'll come back, inshallah, and we will discuss on the other topics. So these are some fundamental things which I had discussed on, that is fundamentals of Wipro or Ambuja Cements, how to study a company, and basically what do you have to do to look into a stock to buy, what are the different investment strategies, and we will be discussing upon the different types of investment strategies discussed by successful investors, and we'll try to see, inshallah, how we can do justice to the other topics. So we'll get back, inshallah, in the next 5 minutes. Let me just Alhamdulillah wassalatu wassalam ala rasulillah wa ala alihi wa sahbihi ajmain amma ba'd. So we received a few questions. We also had received a few people. We saw a few people raising hands. Probably we'll try to do justice, inshallah, by finishing off the session in 45 minutes. There's a lot. I think a few more things which I wanted to discuss about. I'll see how we can surf it through faster. But let me answer a few questions right now. Not few questions. There are two questions which I think I should answer to continue the session because it's also a part of a session. Sister Najima has asked, interest 12% in Biocon. What does it mean? Do they pay? In that report, it was there. Now, it depends on which factor you have selected. Is it interest before, interest before earning? Is the interest deducted from the earning or is it a part of the earnings which they have? Number one. Number two, you have to also consider whether the company is getting interest is paying interest in terms of payables, or is it getting interest because it has cash surplus in the company. Okay, so what is happening is a lot of companies which have cash surplus get interest from the bank, which they yet again consider that as in the interest category. So that is also something which you have to consider. So you have to see the company in different formats. Now the thing is, if I go in terms of fundamental analysis more in detail, what will happen is the other concepts which comes after fundamental analysis we might end up losing on that. So what I could do is, so all those people who are interested in terms of fundamental analysis, as all of you have been a part of our team, we will be constantly updating you in the Halal Investment Network, which we have, inshallah. So this investment network, we have approximately around 280 people who have enrolled. We'll be converting this into a investment network where people can work with each other or help each other grow. There'll be a networking session happening, and inshallah, we will see how they can grow in a Sharia compliant manner. And we will also constantly be mentoring you for the next 3 months. So if you're interested in understanding a stock, if you're interested in doing stock market trading, we are giving you a dedicated relationship manager. You can always approach us, and inshallah we'll be here for you to support you on a case-to-case basis. And inshallah we can also help you in terms of screening the company individually for the first couple of weeks, and then once you're confident in terms of your screening of the company, you'll be able to go there, because we will not be able to cover the entire screening process. It's so elaborate, it's quite interesting in different ways. So if you have to you have to cover all that in this current session, probably it will take another 2 or 3 hours. So we will try to go to the next topics, that is in terms of how to analyze a stock. Right now we have given you, just to summarize till now, we have helped you in terms of understanding how to create the right mindset, how to generate the right attitude, what are the different principles of investments, and how can you fundamentally analyze a particular company, which is Sharia compliant or not. What are the tools you can use to analyze a company? How can you compare graphs? How can you compare financial results? How can you see whether the company has debt, equity? How can you see multiple sources of revenue of a company, and whether a company is being growing significantly in the last couple of years or not? And from this analysis, it's up to you to see whether the company is Sharia compliant or not, because we have given you a brief amount of say a fair bit of understanding on what the Sharia compliant norms are, what industries you need to invest in, what is a debt factor with international rules, what are the ways you have to approach a stock, how you're supposed to enter a stock, how you're supposed to exit a stock. This is something which we are giving you at the moment. As I told you, this is a basic session. Probably we'll be keeping an advanced session for a day where we'll be talking about advanced ideas, advanced strategies, advanced concepts in terms of becoming a better investor into the stock market. Mr. Feroz Alam suggests that we do analysis of few companies and let us know some more parameters in terms of due diligence, analysis of sick companies, as well as of how to figure out whether there is any window dressing done in the financial statement. Now, this is something probably if we focus on right now, that will end up taking the rest of the session. So, inshallah, Mr. Feroz Alam can always approach us. You already have a membership in terms of stock market investing. So whenever you're available on telephone, as well as you can drop in personally, we will sit and give you a complete training and understanding on how to analyze a stock, how to go through a stock, and we can constantly mentor you for the next 3 months as it's a part of the package, inshallah ta'ala. So let's proceed with the subsequent slides. How does Warren Buffett, one of the legendary investors in stock market, choose his stocks? Now, why we use Warren Buffett? Because Warren Buffett is a simple man. Even though he does not believe in Sharia compliant investing, he has used either ways. His way of investing has been Sharia compliant because he's always been an equity investor. Yes, the industries which is invested in could not necessarily be Sharia compliant, because major portfolios of his consist insurance. Now he has banking industries as well. But the way he approaches a stock, the attitude with which he's approaching a stock, the thinking with which he analyzes a stock is something which we're going to study. So what are the things we need to consider here before we invest into a stock? How has the company performed? So right now we discussed about how a company has performed in the last 3 years, 5 years. Then the next thing is how much debt the company has, how much is the exposure to debt, how much interest the company is paying, and how much interest the company is getting for its cash surplus. How are the profit margins of the company? Right now we showed you how to see the profit margins of a company in 1 year, 3 years, 5 years, and 10 years time frame. How to understand the earning per share, how to understand what are the comparative earning per share of the company, and comparing it to the industry peers. So when you're looking at the profit margin of the company, not only look at the company for that particular quarter, not only for that particular year, but also compare it for the previous years, for the last 3 years or 5 years, and also compare it with its industry competitors or industry peers in terms of how they have fared with the industry standards. How unique are the company's products? Like for example, we saw Biocon. Why has Biocon shares gone up? Because it is one of the few companies which has issued a drug for diabetics, which the US has approved, and US is willing to use it for its personal use. So this is something which we need to understand. What are the unique products the company has, or what are the unique capabilities or unique solutions which the company is providing in the industry, comparing it to its market peers or market competitors. And last but not the least, how much discount are the shares trading at? What do you think is the actual value of the company, and what do you think the value of the stock is? Currently, when we saw as example, Biocon was trading at a 52-week high, not even 52-week high, it was trading at a 10-year high. It means the stock is been on an all-time rise. So either probably the stock from here could grow another 10-20% and enjoy the rally, or the stock could fall from here and it's overpriced. So it's high. It's better for initial investors to not venture into the stock just because it's growing and just because it's in an all-time high. It's better to be a little safe here, because when the stock has been on an all-time high, there are high chances the stock might fall from here. But if you're but if you're very clear in regards with the growth pattern of the company, if you know what revenue the company is going to make, or calculate, you are able to calculate what revenue the company is going to make in the next couple of years. You are able to see what projects they have in hand, what approvals they have got. Okay, so probably with this, you are expecting the company to have increase in revenue of another 50%, 60%, or 70%. Then you can enter the stock right now, and then you can wait for the company to grow more in terms of share value as well. So these are the two ways you can approach a stock when it's on an all-time high. So you have to analyze, you have to be careful. Yet again, don't be greedy, don't venture into the market without research and analysis. Go slow, go steady, and you remember there are always opportunities in the market. It's just how you are prepared for the right one, and make sure when you get the right opportunity, you're making best use out of it. The bottom line is buy shares of well-performing companies with minimum debt, a good profit margin, unique quality of products, and when the share price is sold at a discounted range. So you have to understand these are the basic factors which successful investors like Warren Buffett have followed. Always remember, circumstances are not a creature of man. Man is a creature of his circumstances. You have to be able to create your own circumstances. You have to see how you can create value to what you're doing. You have to see how you can convert your knowledge into valuable outcome, inshallah. Next, we'll be coming into different types of investment strategies, or probably what are the different investment strategies people in the market use. So this will help you understand the psychology of the investors which are there in the market. You have passive and active strategy investors. You have growth investing investors. You have value investing investors. You have income related investors, then indexing investors, dividend growth investors, and contrarian investors. So what are these type of investors, and what are their strategies, respective strategies? Passive and active strategies, people who invest into short term, that is 3 days, 5 days, 7 days, 10 days, 15 days. So they come in for a short amount of value. They do intraday trading, they do future and options, or they probably see some value in a company for next 5 days, 6 days. Dead cat bounce. Dead cat bounce is basically passive or active strategy. So every week you see companies which are going through dead cat bounce. You come in, get that 4% or 5% return, and then you exit. So a lot of people who come under these categories are called passive or active strategy investors. What category Sharia compliant investors should come under is growth investing or value investing. we will give you a difference between growth investing and value investing. Growth investing is something like companies like Tesla, Google, and these are the companies which constantly are growing very fast on a yearly basis, and they're growing on basis of technology. They grow fast, they burn cash fast. But what is value investing? Value investing is companies like Apple, Coca-Cola, or you can probably say McDonald's, is giving you examples, who have been in the industry for more than 80 years, 70 years, and they have been sustaining for a long period of time, and they have been growing comfortably. But they have also been making sure they're maintaining their market share, and they're still dominant factors in that particular industry. So the difference between value investing and growth investing is companies which are under growth investing are fast growing companies. They grow significantly fast, they do big expansions, they bring in big money, so the share value is heavily fluctuative. With value investing, that's not the case. People invest in the company for the brand they have, and they are happy with the limited dividends which the company gives at the end of the year. All they want to do is to hold the stock for 10 years, 20 years, and get the little dividend which they're getting at the end of the year. Income investing is basically to invest into the stock market with the intention of getting short-term income. That is, on a monthly basis, you want to make 10,000 rupees out of the market. So you come inside the stock market with an intention of making 5,000 or 10,000 rupees, and you invest in different formats, in different strategies, in different companies, to make sure that you get that necessary income which you want. This is something which is risky, because when people are looking forward to make a revenue out of stock market, they end up losing more money than they thought of. So this is something which you have to be very careful about. Don't go into income investing. Try to see how you can make value out of your investment, or either grow your investment into a strategical manner. Indexing is people investing into Nifty 50, or into Nasdaq or S&P, or any other index which holds multiple indexes, or any other index which holds multiple companies. So investing into index particularly means you're purely playing on future and options, or you're purely hitting on a bidding concept, where you're just looking forward to play with the sentiments: enter today, exit tomorrow, enter today or exit today, and the end of the day, which yet again is not Sharia compliant. Intraday is not Sharia compliant. Future and options are not Sharia compliant. And unless and until you do not do intraday or future and options with indexing, you will not be able to make money. So I would suggest you go with value investing in terms of studying a company, analyzing a company, and knowing where you're investing and why you're investing. And that way, inshallah, you'll be making a revenue even when the market goes down, or even when the market goes on top. Dividend growth investing. Dividend growth investing is more or less parallel to value investing, but value investing is more of companies which have been into the blue chip categories. That is, companies who have been very big, established for more than 50 years. Dividend growth investing is where you invest in companies which are known to give regular dividends, like government companies, companies which are backed by some international companies. So this way, what happens is, these companies on a yearly basis, they grow or not, they make sure that they give you a significant dividend of at least 10 rupee per share or 15 rupee per share. So you're looking forward to invest into companies only for the dividend value on an aggressive basis. So this is something which is considered as dividend growth investing, and it is something which goes with long-term investors. What is a contrarian investor? A contrarian investor is basically someone who comes in only when he hears a specific news or specific information about the company which he finds out. So he comes in for a brief period of time. If he knows that suddenly the market is collapsing, he will come in, he will buy a big value, and he will immediately exit in 2 to 3 days. So a contrarian investor is someone who waits for that opportunity, who waits for that impact, and immediately when he gets it, he makes big use out of it. So he does not invest the whole year. He probably might invest a couple of times in the whole year, but the revenue which he will generate, the value which he will generate, will be way more higher than the other values which these other investments make. Different types of strategies in terms of investments have been day trading, scalping, news trading, swing trading, and trend trading. All of this has been happening in the market currently. So day trading, we know intraday, where people buy in the morning and sell in the night without getting the delivery of the product. This is something which we have been suggesting from the starting of the course is not Sharia compliant. It's better you come in with a calculated risk and calculated understanding of the stock, and hold it till the time you achieve the target which you want to achieve. Generally this is done, day trading is done with 5 to 30 minutes interval, or 5 to 60 minutes interval. They buy sell, buy sell, buy sell. So they're trying to make 5 rupees, 10 rupees per buying or per selling. At the end of the day, they look forward to make at least 1,000 rupees in terms of whatever they've bought and sold. So that is something which comes into day trading. Scalping, that is taking small profits to buy or sell by rapidly entering and exiting. So this is something which generally correlates with day trading, but here you are coming inside only a few set of stocks to get that 20 rupee margin or 30 rupee margin per stock, and exiting, trying to target a few stocks per day with a bit of calculated risk. Intraday is purely with a blind understanding in terms of charts, in terms of software. Scalping is more of analysis, whether the stock has probably has a range potential, and you can see a stock growing another 20 rupees. You enter the stock and you exit the stock in a short term basis. News trading is where you see a news about some collapse, some panic, or some war or something happening which immediately impacts the stock market. And that particular point of time, you decide to enter the stock just to make use of the news which has been issued in the stock. Say, for example, recently there has been a news that Walmart is going to invest 20 to 25 billion dollars in TCS into an app alone, so that they can venture into the retail industry through Flipkart as well. So you can imagine, if Tata Global Services, that is Tata Groups, has around more than 100 plus conglomerates in the FMCG industry. So if Tata is bringing in Walmart inside, the amount of firepower which will be coming with Walmart and the experience which Walmart will bring, this way there will be a huge competition for Reliance in the market. And this news is something which is increasing the share value and share prices of all Tata companies. So this is news trading. You come inside with a particular news for a brief period of time, enjoy the rally, and you exit. Now, swing trading is basically investing for either an hourly basis or daily basis, or at least into 2 days or 3 days basis, because you know that you know a momentum of a stock. A stock will rally between 50 rupees to 100 rupees in 7 to 10 days. So when you understand that particular rally, you enter the stock when it's a lower rally, and you exit the stock when it's in a higher rally. And again, people sell the stock on a higher rally and enter the stock in a lower rally. So this is what is happening in swing trading. All these things which is happening in the market, trading, that is when the market is constantly going up, people are investing and buying. It is merely just because you're copying each other. So these are things which are happening in the market in terms of strategies which are making the prices extremely fluctuative. So you need to understand why a stock price is going high. Is it because of day trading? Is it because of news trading? Is it because of scalping? Is it because of swing trading? Or is it because of trend trading? Once you are able to eliminate these things, you will realize that your investment which you're making is of what safety, of what value, and accordingly you will be able to nullify the risks which are involved with the investments in those particular stocks, because an investor comes in for the value of the stock, not because of the fluctuativity of the stock. So if you are investing into a company, you should be able to eliminate the fluctuativity of stock by understanding why people are playing here. Is it because of trade trading, or is it because of swing trading, or is it because of news trading? If it is news or trend trading, it is value for you as an investor. But if it's scalping or day trading or swing trading, you know that a lot of people are playing around. So when the stock will fall more, or when the stock will increase more. So these people who come under these three categories are people who control the price of the stock on a temporary basis. Suddenly they'll push the price of the stock 10%, or they'll push the price of the stock down 10%. So this is something you have to consider to reduce the element of risk which comes with fluctuativity. Now, what some famous investors preach and say: strive to become a value investor and not a speculator. This is something which Mr. Carl Icahn, one of the shrewdest investors in the world, he is known to make extremely shrewd, crazy investments, and he is known to be a villain in the investment industry. He randomly penetrates companies. He just comes inside, invests in share market, big value, takes shareholding, comes and sits on the board, and totally changes the company in all directions. So he is very aggressive. He's very shrewd. He says tries to become a value investor and not a speculator. And to revise, what is value investing? Value investing is where you know why you're investing, for what you're investing, and what is the risk which comes with that investing. Don't let what other people say disturb your mind. Be happy. Now, this is something which has been told by one of the famous hedge fund investors. He is a person who owns Blackstone, and this person has constantly preached about the fact that don't worry about what other people say and disturb your mind. Be happy in terms of your investment. That will happen only when you're clear in regards with your study and your analysis of the company, and you're not constantly reading random news, or you're not going through random people saying, okay, this company will go up, this company will go down, this is going to happen, that is going to happen, the economy is going to collapse, India is hollow, another lockdown is going to come. All these news should not affect an investor, irrespective of the fact he's investing in the stock market or even though he's running a business. When you're running a business, you know what your company is capable of, you know what your business is capable of. You need to be limited and focused to what you can provide and what you can do. Don't worry about what the trend is, don't worry about what's happening outside. Yes, that has a bit of effect, 5%, 10%, 15%, but if you're able to do things right, you will actually be able to make use of that negative situation outside to the best of your capacity, which you have seen during this lockdown. A lot of successful companies have done to convert this negative situation into an extremely positive situation. John C. Bogle, one of the legendary investors and also the oldest investors, he's Canadian, and he's known for his famous Vancouver Index. And he says, learn every day, but especially from the experience of others, it is more cheaper in terms of money. So see how what mistakes other people have done in stock markets. See what you can find out in regards with what are the different strategies and principles people had followed, how they lost money, how they gained money. Do some study, do some research on successful investors, and you'll have a fair bit of idea on what are the mistakes that they did and what are the mistakes you're not supposed to do. One of the very famous, one of the most famous saying that is by the famous Warren Buffett: what is the right time to invest? Be fearful when others are greedy, and be greedy when others are fearful. Now, this doesn't necessarily mean when the market is falling, you just enter the market blindly. Whenever you're looking forward to invest in the market, this is what is the actual definition of waiting for the right opportunity. So when we invest in stock market, I personally never keep my money constantly investing in the stock market. I invest only when I see an opportunity. I invest only for a particular time frame which I have in my mind. Say for example, I had some money in my hand. I never invested in the market. When I saw after March the market was falling, probably I decided to invest some money to get good returns out of it. And similarly, I again, once I get my returns, I exit and I keep the money in my hand. So the idea is, I personally don't invest constantly and don't try to put myself into the market the whole time. I try to keep my surplus in my hand, provided a little bit of corpus fund in the market just to get the rally of the stocks. But for me, it's more comfortable when I constantly watch the stocks or watch the market. So one fine time, I know now, okay, yeah, I know when I enter right now, probably there'll be a good rise, because I'm coming in only for that value which I've been waiting for the whole year. So I'm preparing myself for the opportunity which I want to take. So that's the time when I feel, and for me, the time when I feel there's most opportunity is when the market is falling, when the people are selling in the market. That's the time when I feel there's a good opportunity and we can make good money out of it. Never try to play a macho man with the market. Second, never overtrade. It's important that you do not try to outsmart the market. You do not try to prove something to the market with your ego that, yeah, I can beat you, yeah, I can make more money. It doesn't matter, I will do it. Don't go into that macho man game. This is where most of the people lose their money. This is where most of the people end up doing big mistakes. This is the most common, simplest, and the most biggest mistakes people do in the stock market, especially during basic trading. They end up losing money in a particular stock. They again go back to the same stock in the same day or in the second day just to prove themselves that they'll make money out of this particular stock. The rule is, once you make loss in one particular script or one particular window, you do not enter that window on the same particular day. The rule which I particularly follow, what I have learned from my mentors, is if I make profit in a particular script or particular stock in a day, in a particular day. Say for example, I invested 5 days back, 8 days back, or 1 month back, or 2 months back. Finally, I got my target. I exited and I made profit. Just because I made profit, if I decide to invest in that stock again, probably seeing, okay, I can invest now a little bit and I'll go. No, that is not the rule. The best way to do stock market investment is, if you have made a profit and you've exited the stock or the window, don't go to the same window the same day. If you lost money in a particular window, don't go into the same window the same day. Once you made or lost, You do not enter the window again, because that way you end up losing the money which you've made, or you end up losing more money than what you have lost. So this is something which you have to understand in terms of some basic policies. Do not overtrade, and do not try to prove anything to the market by playing the macho game with yourself. The biggest threat is to make good the biggest threat to good decision making is harmful emotions. Now, decision making is a two-step process. Learn first, then decide. This is something which the famous Ray Dalio has said. Ray Dalio has a track record of outperforming the market at least 15 to 17% every year for the last 22 years. He is one of the famous investors who invests into different hedge funds. He's made money even during recession, that is the 2008 recession. So he says never get attached to your stock. The biggest thing which affects a good decision is the emotions which you attach to the particular decision making. So to avoid emotions, learn the stock well, and then decide, and then when you get your target, exit the particular stock. As I mentioned to you, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. We have to be able to constantly be disciplined about what you are doing. Stick to the basics. Don't go don't try to do a lot of things. Don't try to learn a lot of things. Focus on your basics, and inshallah, with those basics, once you achieve your target, exit, and inshallah, Allah will give barakah in it, and inshallah, you will see a significant growth in it as well. A little bit about how to train on the online platform. We have around 30 minutes. In that 30 minutes, I have to wind up within 15 minutes or 20 minutes so that we can take some question answers. There are some screenshots in regards with how to invest, because all the people who are in the session, we have given them inbuilt offer in terms of how they can open a demat account. And we'll also teach you in regard, we'll also support you in regards with opening a demat account and give you a 3-month incubation in terms of how to study the market, grow the market, understand the market. You can always approach our team, and I will introduce you to our associate partner from Religare platform, Mr. Barani. Mr. Barani will help you in regards with all the necessary formalities to open the account. In regards with NRI accounts or domestic accounts, he will constantly help you with any doubts you have in regards with the software, in terms of how to invest, how to buy, how to sell. Or if you want a portfolio manager, not portfolio manager, if you want a manager probably to support you in emergency situations, probably you're traveling somewhere and you want to buy something and you see an opportunity, you can always give him a call. We are just associated because Religare has given us an tie-up platform. We are going to do is we're just going to observe and watch the stock, and this way we can at least guide you on a constant basis. A few screenshots. I will not go much in detail. How to create a market watch list with the software. Probably I will go in terms of this for a practical session for 5 minutes now online. Order and trades. How to place your orders. How to do the trade. Then how to place an order in particular. You have to be able to put which exchange, NSE, instrument, equity, from which place it is nifty, and then you have to do the order type and the validity, and then you have to put whatever price you want. So it depends whether you want to keep a stop loss when you say when you're particularly investing in a stock on a small term basis. It is better you do not go with stop loss models, because it is important that you get into a stock with a particular time frame. This will avoid the stress of the stock, and don't worry about it. If you have a particular analysis of a stock, try to see it once in 2 days, once in 3 days, just to figure out what you've thought about the stock is right or wrong. How to buy an order, how to place it through the menu, some screenshots about the software. This is generally how it's done. Probably we will try to show it to you with a live demonstration now if we can. How to place a sell order. You can place a sell order in 2 ways, either through the market watch or to place an order window. So you can either do it through order window, which you can place and individually place an order specifically, or you can do it through market watch, where you place an order and it goes on the market pricing. Selling, again, this is the thing. Order book, you have to, at the end of the day, if you want to know what are stocks you're holding, what price you bought it at, and what price you want to sell, what is the value of the holding, how much the price has gone down, how much the price has gone on top, what is the percentage of profitability, everything will be shown in the order book. You will have a clear idea about what is the value of your stocks and how much you have made now, even your previous trades, and what is the overall profit you made in a year. A trade book shows the transactions you have done on a daily basis. It shows you the amount of your transaction, the order ID of your investment, as well as the product type which you have invested in terms of delivery product, in terms of delivery and intraday. These are the two products in which you invest in equity market. We are encouraging everyone to invest in delivery. Intraday is something which we are not encouraging anyone to do, as we do not consider it to be Sharia compliant. So we would suggest, if you're going to investment, you always mention the delivery box. All this will be personally, all those who want to invest into the market personally and want help, our team will take care of your necessary support. We'll give you all the training whenever you require, all the support in terms of investing into a stock, how to start. We are not going to do anything for you. The whole idea of this session is to make you self dependent, to be able to help you understand in such a way. You have an app for the software also, so you can buy and sell from your phone. In regards with how to use the interface, how to do it, how to manage it, any doubts, will constantly keep guiding you. But we want you to be self dependent so that you can make your own decisions and you can actually take it forward from there, inshallah. There are a few types of orders, that is limit buy order or stop buy order, stop loss order, and limit sell order. This generally is more useful in intraday. So if you're going in terms of delivery on long-term investments, you don't have to worry about this. Probably we can explain about this on a personal session. Let's see what we can do in terms of live trading now. So this is how we go. We go to the Religare website online and we try to sign in. So I sign into my profile, say Jubran Siddique, and try to place an order. So I try to see which company I want to buy. Say, for example, I'm mentioning Biocon Limited here. I try to choose Biocon from NSE, and then let me just log in. Okay, so now once I log in into my platform, you can see that there is the stock value, lower circuit, now upper circuit. Today the stock has crossed 500 rupees. So today the stock has touched the 52-week high of 501 rupees. So now I'm trying to see what is the value in terms of volumes. We saw in the morning there were 3 lakh people. Now we see that there are 6.7 lakh people who are totally trying to buy the product, and there are totally 6.79 lakh people who are trying to sell the product, and 4.79 lakh people who are trying to buy it. So there are more buyers in the market than sellers. So a lot of people are feeling that the price would fall from here. Sorry, the price has not touched the upper circuit, but this is the value maximum. This is the value to which the product can go today. So now I mentioned what I want to do. This is delivery, order quantity. Probably I want to buy a share of stock, and then I can choose the price which I want to buy at. So probably I can mention it is 450. Now it's at 453.94. So 454 is what I'll mention, and I will place my order. So it says confirm the order, delivery, exchange, NSE, and what it is, limit, and then order validity for a day. Probably let's see what is the order validity here. Yes, the order will be valid today. So probably if I want, I can cancel it as well. But I will be going for a long term, so it will be getting converted into a delivery model. So confirm order, and then my order is sent, and I have successfully purchased or bought a share of Biocon in my account. So this is generally how we end up doing trading in terms of live market. Here you can see, you can place an order here. You can have a watch list of your stocks, my positions, which I'm holding right now. I've tried to buy Biocon, so it will come into my watch list, or I've not yet added any watch list companies into my stock, so I can add 5 or 10 companies. I can constantly watch them in my stock. The orders which I have placed. So today I have placed the order, that is Biocon. I bought it at 654. The order has been completed, and I have not yet completed. The status is pending. So it means I've not got the stock at 454 rupees. Probably I might get it for a higher price, or I have to change my price again and get it for whatever price is there in the market. So the order is still pending. Now, what are the completed orders I've done? What are the pending orders? What are the historical orders? You can check here. Then the different type of trades I've made in a day. what are the positions I'm holding. So I have only one stock right now, that is the only stock I'm holding. Okay, so the order has been executed. I've got my order. So right now the net value of my investment was 454 rupees. Now unrealized profit and loss is 10 paise or 45 paise. You can see that. So this is generally how I can watch my profit and loss of my portfolio. So now I've made 50 paise in terms of margins immediately after placing the stock, and I'm looking forward to see how much I can make in the next couple of days. Gaining positions, how much I've gained, how much I've lost in the last couple of transactions, or how many transactions I've made till now. Holdings, what all stocks I'm holding, what is the trading limit I have, what is the margin. So this is something which you have in a very comfortable, simple format, and you have everything available here in terms of what to do with investments. Let's go with the okay, so we have gone with the live trading. We have just showed you a basic outline about how the live trading is done. We have shown you in regards with how you are supposed to study a stock, how you have to analyze a stock, what are the basic things you can go through. And probably we've tried to do our best to justice to cover all aspects, because we understand there are few people here who understand the stock market. We understand there are a lot of people here who do not understand the stock market. So while making this course, it was very difficult for me probably to do a balance, because we all understand, finance is a very boring topic. So at the end of the day, I need to make it interactive for you, and it's a 3-hour session. Probably I personally wouldn't sit for a 3-hour session, but I have to do justice for the value of content which is available. So I had to make it a 3-hour session, and it was more challenging for me to make it more valuable for you. And at the end of the session, I want to make sure you take something out of it, wherein at least you feel powerfully equipped enough to become an investor on your own. At least you can take that step forward, and you know the right pattern in terms of how you want to grow. So here we don't want to stop with these 2 days of session, the session of these 2 days. That's the reason why we brought in an incubation model, where for the next couple of months we want to constantly support you and guide you. This way, at least you'll be able to make a difference in your life and also in the lives of the people around you, inshallah. How to make a successful portfolio investment. An investment portfolio is basically a collection of assets. Not necessarily it needs to be only equity. It could be equity, real estate, it could be commodity in terms of gold and silver, and many other things. So the idea of making an intelligent portfolio is where you balance the risk in terms of what comes with each investment you make. So the portfolio should be made in such a way that you're able to make profitability in any market condition. So the right portfolio is made in such a way where, when the market is collapsing, one particular investment will go up. If the market is going up, one particular investment will go up. So there should be a balance, there should be a hedge, there should be a support system within your portfolio, which will constantly generate revenue for you at any point of time, not only in the stock market, but in your personal portfolio, which you maintain in your life in terms of growing your wealth. A few industries which you can use to diversify and reduce risk. Basically, how you can maintain your portfolio. It is diversification to reduce risk. Various methods to diversify. You have to see what are the different types of diversification. Do statistic modeling to determine what is the optimal level of diversification you can do, and how actually can beginners diversify. These are the few questions which I would be answering in terms of portfolio management services, or making your own portfolio. These are some international standards of Sharia-compliant diversification, how people diversify in terms of investments. So people like to diversify in these factors which come under the Sharia-compliant norms. So for people who have a cash portfolio, people who have some sort of a significant cash flow coming in, they ask what is that they can do to diversify their investment. So probably you can focus on a model like this could be of some use or benefit to you. These are some industries which constantly have its own benefits. You have healthcare industry, telecom industry, energy industry, and preferred stocks. Preferred stocks is where you can be a part of a company, a successful or a growing company. Say for example, there is a company we are working on, and the company I'm seeing is growing for 10 years, and probably next 3 years I feel they can grow much more and they can go public. So I come in now and take preferred stocks in that company, give money, become a shareholder and a director in that company, and try to wait and help them become public and get a maximum benefit out of it. So that is one way how I can diversify my portfolio. The second way I can diversify my portfolio is by diversifying my investments into stocks in different industries, that is energy, telecom, healthcare, IT infrastructure, and logistics, and try to see how I can balance my portfolio in the hedging model. Like as I told you, say for example, if I would have bought Reliance because of the oil, I would have bought Asian Paints to diversify the risk which comes with oil, because Asian Paints depends on low pricing of oil. Reliance depends on high pricing of oil. So this way, if the industry is dependent on an underlying commodity, I will try to see which industry benefits when it goes down and which industry benefits when it goes on top. So this way, I'm able to balance my portfolio. This way, I'm able to maintain some sort of a parallel in terms of creating revenue. And different utilities, telecom industries, telecom is basic necessity right now, so that is a good portfolio to invest into. Healthcare is growing, especially after COVID situations. Companies which are working on vaccinations, so companies which are significantly working on corona related services, all pharmaceutical companies are growing aggressively. REITs, real estate investment trusts, you can invest online into real estate investment trusts. These are companies where REIT is an organization which holds assets and gets revenue only out of rental incomes. So you can understand a company which is a REIT and which is published in stock market gets its revenue only through rental income, and how safe it could be. The stock will not grow aggressively, it will grow slowly, but it will give you a significant return constantly, inshallah. A fixed income model, probably you can see where you can what cash flow you have, that will be a fixed income, but also try to see how you can add some dedicated revenue on a monthly basis to your cash flow pattern, which will help you diversify your portfolio better, because once you get a dedicated cash flow, you can use that money to actually rotate into your different portfolios. And that dedicated cash flow could be either your income, could be either your savings, could be either your return from some other investments, but there should be some sort of a dedicated cash flow, at least on a monthly basis or a quarterly basis or a half yearly basis, will inshallah help you develop your portfolio more. That dedicated cash flow should not be interrupted for any purpose, because that should go into developing your portfolio consistently for even decades, inshallah. Then probably you can look forward to invest in something which is a high dividend yield, not necessarily into stocks alone, but it could be as a seed investor, where you can invest into some upcoming companies as a seed investor, or as an angel investor, where you can see for some good projects and you can see how you can make use of these projects, but provided you understand the industry well, provided you understand the concepts well, and provided all these things come under Sharia compliant norms, fundamentally, as well as in terms of how you're doing a transaction. This is something which international companies, governments, and international fund houses do to diversify their investments. They invest 7.5% in gold. They invest 7.5% for revenue from real estate, that is rental income or commercial income. 15% in intermediate bonds, that is sukuk, which is halal bonds. They focus on this, which gives them security of the investment. Now comes the tricky part: only 30% in stocks. If you can see, all the biggest portfolios, all the successful fund managers in the world use this as a common formula, which is something which I've done, which I've been studying for the last 10 years. This is a common formula which I've come up with an aggregate, where they don't invest more than 30% of their corpus into the stock market, because they know that 30% itself is enough to get you a good return. So this is something which we need to understand. People end up putting 100% in the stock market and get worried when the portfolio is not growing. So it's important that you are able to diversify your portfolio in a very safe manner, which will give you returns in different formats. So this portfolio is studied, appreciated, and also proven in terms of generating revenue in any situation. So 30% investments into stocks and 40% investments into long-term real estate bonds. Now, this is not something which is available in the market right now. With long-term real estate bonds, we are talking about companies which hold real estate assets, or infrastructure units which hold real estate assets. You can invest in those companies as bonds which are backed against real estate. So you have a liquidity. So whenever you want to encash your investment into real estate, you can do it immediately through a bond model. So this is something which REITs do, that is real estate investment trusts do. We do not have REITs in India. Probably we have only two, and out of which one is a private REIT, one is a public REIT. And inshallah, we very soon we intend to bring a REIT model to India, where people can invest into real estate, but more on a liquid format, where they can make use of that asset which they have invested into whenever they need. Because right now the problem is people have assets, but when the cash flow is not there in the market, they end up losing the benefit of the asset. So they cannot sell an asset in today's situation. They'll get a price much lower than what they bought it for. So this is the problem with real estate, that you cannot sell it at the price which you want at the time when you want. So this is something which we are looking forward for different solutions in the Indian industry, and inshallah, hopefully, we'll come up with it soon. A few basic things. What is the difference between growth stocks and value stocks? As I told you, Netflix, Amazon, Uber, these are companies which grow aggressively and faster, and they also usually they do not pay dividends on a yearly basis. They just go faster, and you make your return out of the growth value of the stock. Value investors are companies like Coca-Cola, Procter and Gamble, P&G, McDonald's. Just for examples, this doesn't mean we are considering them Sharia-compliant. This is just for an example. These companies grow slowly, but they give you an annual dividend dedicatedly and meticulously for your investors. Three bucket system by Tony Robbins. This is something which he suggests in terms of how to diversify your portfolio, how to strategize your portfolio to get returns. One is the security bucket, the other is the risk and growth bucket, the other is the dream bucket. So as a person who wants to develop wealth, you need to create three segments for your cash flow to be diversified into. One is the security bucket, which basically won't yield a lot of return but are very unlikely to make you lose money. So your money gets converted into an asset. It is safe, but it doesn't give you heavy returns, but it gives you a sufficient return which avoids the risk which comes with it. A growth bucket, which has a little riskier investment, which basically beats the average return which the market gives you into a long run. A little volatile when it comes to their terms of fluctuation, but in the short run or in the medium run, they'll be able to give you whatever sufficient returns you can pan out with. So it is suggested that you segment your buckets into three halves. The first one is security bucket, the second one is a growth bucket, and the third one is a dream bucket. A dream bucket is where you get some profits you make from the other two buckets, and you diversify that into this bucket to get what you want in terms of growing your wealth, or in terms of achieving your dreams or your targets. So example, 10% of your portfolio value at the end of every year. So 10% of your first two buckets should come into the third bucket, so that you are able to generate what is required to achieve your dreams, inshallah. Few basic interesting facts. The rule of 72, which I told you, where if you want to know how much time it takes to double your investment, the formula is just divide the rate of return with 72, and you will know how much year it takes to double your return. Say for example, if you're making a return of 2% per month or per annum, you'll take 36 years or 36 months to get your 35 years or 35 months to get your actual return. So similarly, if you're making 25%, you will take approximately 2.9. If you divide it, you will take approximately 3.11 years for you to get your 100% back. So this is the rule of 72, which is applied for a lot of things. It was made by a very famous scientist. He suggested that if you want to know exactly how much time it takes for you to multiply your capital 100%, you need to divide the return which you're getting by 72, and that way you will know how many years it will take for you to double your investment. The biggest and the most costliest company in the world in stock market is Berkshire Hathaway. The value of the stock is over 2 crore rupees, and the per share is more than 2 crore rupees, and this is the most valuable stock in the world right now. Market capitalization of just two companies, that is Tata Consulting Services and Reliance Industries Limited, is equivalent or more than the whole of Karachi Stock Exchange, which is there in Pakistan. So you can understand the value of market capitalization and how much you increase the value in the market that will benefit you as an investor. So you have to see what are the companies which have a significant market capitalization. This way, they will be able to sustain any negative which comes into the market. A few tips, probably, as we have discussed a lot about investing into stock market, and we have discussed a lot of other things which comes with investing into stock market: personality, development, character, approach, mindset, graphs. So this all these things are the fundamental things which you require. But in my personal experience, I would like to end off my session by giving a few tips in terms of how you can increase your wealth. Now, this doesn't necessarily mean that I'm a person who's wealthy, or I'm a person who has significant wealth. This is something which I have learned from my mentors, This is something which I have significantly learned from a lot of people who are successful, and I'm constantly learning from them. And this has made a significant impact in my life and the lives which I've been observing, and the lives of the mentors I've been seeing. So the first thing is avoid riba, avoid usury, that is dependence on loan or dependence on borrowed money. So what happens is in this, whenever we looking forward for taking money in a borrowed format, we are programming our mind to buy something which we do not have with the money which we do not have. So you are ending up buying something on a loan because you want to meet with your needs, or meet with your ideas, or meet with your goals in borrowed money, which particularly you're programming your mind in a very negative perspective. All successful investors are suggested not to borrow money, because this way you're programming your mind to say you always have enough. Because only when you're saying, only when you're not borrowing, and only when you can buy what you can afford to buy, is when you're programming your mind that I'm more capable of getting what I want, and I will achieve it in in a better format, and I will not look forward to take loans, or I'll not look forward to pay interest, because as we all know that paying interest has its own consequences, and Islamically it's like waging a war. So we have to also consider how important it is to avoid riba, because I don't want to go into technical formats of Sharia. I would rather say what are the personal developments which being debt free helps you with. Probably the next concept will be to show gratitude. Showing gratitude is very important, because that helps you in developing a positive mindset. It's called the law of attraction. The more you're able to share positivity, the more you're able to appreciate things around you, the more you're able to appreciate things in your life. Shukr is something which brings tremendous barakah in your life. It brings tremendous positivity in your life. In any worst situation, you have enough amount of things to be happy about, enough amount of things to be thankful about. So it's important that you're constantly in a state of shukr, you're constantly in a state of gratitude, where you're able to thank Almighty for the things you have around you, and the things He's given you till now. And inshallah, you will see a significant rise in barakah in your lives. Istighfar, seek Allah's forgiveness. Allah says in the glorious Quran, فَقُلْ تُسْتَغْفِرُوا إِنَّهُ كَانَ غَفَّارًا. Ask for forgiveness, and Allah will bless you with bounties. Allah will give you children if you don't have. Allah will give you rizq if you don't have. Allah will give you barakah if you don't have. Allah will give you rain in a land if it's barren, if you do not have. There are so many benefits of istighfar. Allah says in the glorious Quran, the Prophet ﷺ said that if you do istighfar and if you do salawat, that itself should be sufficient for you to get all what you need. So it's important that you be accountable for all those people who do not understand the concept of istighfar. Istighfar is nothing but accountability, being accountable for what you have thought, for what you have done, and for what you're going to do. The more you're accountable, the more you increase your value. The more you're accountable, the more you're true to yourself and to the people around you. Last two, something is to keep family ties, maintaining relationship with kith and kin. This is something which is important. The more you're able to maintain relationships with your kith and kin, the more you're able to grow in terms of nature. This way, you're able to help people around you. You will see a lot of development. You will see a lot of barakah in your business as well, because it is the famous hadith of Prophet ﷺ that people who maintain relationships with their kith and kin grow in terms of portfolio, grow in terms of risk, and in terms of sustenance, in terms of life as well. So this is something, inshallah, which will add barakah to you, and this is something which is a very difficult thing to do, because this is something which it's told that the most difficult thing to do is to do dawah to your family, or is to be in relationship with your kith and kin, and this is something which you have to work upon, and this, inshallah, will help us be united, and it's also help us be more positive in a longer perspective. Last but not the least, spend in charity. With charity, I would like to emphasize on the concept of zakat, because zakat is something which brings tremendous revenue into one's life, and this is something which is very important. Uh, Sorry, yeah. So zakat is something which I spending in charity is something which I will highly encourage a lot of people to do. With spending in charity, it doesn't. I need to add one more point, that a lot of people, when they spend in charity, or a lot of people who are doing something for Islam, do not understand the value of secrecy. Being secretive, being secretive about the deeds you do, about the things you are doing, gives tremendous barakah, because the best of deeds, fasting, the best of alternative prayers, tahajjud, the best of charity, and the best of things which you do in this life are the things which are in secrecy. The more you are in secrecy, the more you have barakah in your life. You don't have to necessarily show what you're doing, how you're growing. Inshallah, Allah will give you barakah in it. And making sure that you're able to value zakat over everything else is very important, because the people who value zakat, the people who are able to make Allah subhanahu wa ta'ala partner in this business, Allah will inshallah protect their money, and inshallah Allah will able to help them grow their investments as well. To finish off the slide, lastly, I generally encourage people to think big, which I feel is a good mantra for success. With big, I mean the books you read. There's a famous concept called 80-20. So if you are able to read even for half an hour a day, you will realize at the end of the year probably you would have finished at least 12 to 13 books, which is way more than what anyone else does generally. So the more you read, the more you gain knowledge. The more you gain knowledge, the more you're able to be ahead of the market and ahead of the people around you. I stands for the individuals you meet. It is the people you meet which is very important. That's the reason it's said the character of a person can be judged by the friends they have. So it's important to constantly surround yourself with the right individual. It's constantly important to surround yourself with people who can push you to become better, with people who can teach you, with people who can you can with people who you can grow and you can learn more from. So constantly try to have the right individuals around you, have the right mentors, have the right people to guide you and constantly help you become better individuals. And last but not the least, the goals which you keep. A lot of people keep goals, but it's important to know how to achieve it. There is a rule called the theory of 20, where it is said if you can draft down 20 different ways to achieve a goal, it's highly likely you're going to achieve that goal. Now, to draft down 20 different ways to achieve a goal is very difficult. Probably you want to become a billionaire, or probably you want to become a millionaire. To draft down 20 different ways on how to achieve it is going to be very tough. But inshallah, if you can do it, you will see inshallah your goals being achieved significantly. Wa akhiru da'wana alhamdulillah rabbil alameen. I would like to thank all of you for your time and effort and your support to be a part of this association, to a part of this workshop. May Allah Azza wa Jal make it beneficial for all of us, and we inshallah look forward to grow together through the halal investing group, and to add more value in each other's lives together, inshallah ta'ala. So I will take a few questions now. Probably I think it's 10:29 already, but let's see what best we can do in terms of questions, inshallah. Yes, in regards with the recording, we will be sharing it with all the people who have registered and enrolled for the session, and we will be giving the recording of the session, so you can go through it again and you can have a fair bit of understanding about what all things you have missed. Okay. And I would request all of you to fill the feedback form so that it will be I would request all of you to fill the feedback form so that it will be easier for us to understand what we can add, what we could minus, and probably what you felt could make an impact. So this way we can make it better for our subsequent sessions, so that we can make the session more interesting, more impactful, and more valuable for people. As this is the first time probably we have discussed on something called stock investments. There's something we did with the intention of just helping other people to be able to generate alternative source of revenue. This is not only for men, this is for women, and also, and a lot of people can sit at home and try to see how they can make their money work for them. Let me see. You have the forms in the link below. Probably you can just give us your feedback on how the session was. One brother says, mashallah, brother, given good opportunities for me till I have thought and asked more people about stock market, and it was told that it is fake and haram, but you revealed that we can invest in stock market. Stock market is a big question, but I learned little drops from you. Thanks again, once again, jazakallah khairan. It's all Allah's guidance, and we hope that Allah helps us to contribute more. So you want some suggestions in regards with stock market updates and magazines? Provided you can contact me, and I'll give you a few suggestions, inshallah. Thank you, brother Radnan, for your feedbacks. And other than that, I think inshallah we have answered whatever questions you have asked. What about the paper stock assignments we talked about yesterday? Probably we can discuss about this. We will be discussing on individual basis. We will discuss about how the paper stock trading has gone, and this way we will be constantly guiding you with your paper stocks for the next 1, 2, 3 weeks, and see inshallah how we can do it. With the Shahul Amid has asked for the recordings, inshallah we'll be forwarding it to you. Mr. Owais Siraj has asked, who are my mentors? from the stock market. I have a few mentors. Dr. Amjad Khan Suri, he was my HOD in finance, and he was my person, my go-to person in college. He has 25 plus years of experience in the stock market. He's currently HOD for Islamic banking and finance in Khawarij University in Dubai. I have Mr. Moses Harding, which is one of the legendary figures in the investment market. He gives us inputs in regards with how the investment market should be approached upon. Then I have a mentor, probably, who I go to when it comes to stock market investing. It's my friend's father. And then we have two other people who had taught me during my college times in regards to stock market investment. One is a good friend of mine. One is my faculty, that is Sheikh Abdul Salam Madani. I ask him for all the factors when it comes to Sharia compliance of stocks and whether we can involve ourselves in these transactions or not. And another person who helps me when it comes to mentorship is one friend of mine whose name is Umar. He again, yet again, stays in Dubai, and he's been an aggressive investor in stock market for a long period of time. So Alhamdulillah, for now, I think we have answered all the questions. We ask Allah Azza wa Jalla to make it beneficial, and I would like to thank you all once again for your patience and your time with us. And we hope that you have benefited out of the session, and we hope that you're able to make best use out of it. And you can always come back to us. You can always follow up with us, and we can make sure we can try to help you in the best way possible to be sustainable in the market, inshallah. Jazakallah khairan. Assalamu alaikum wa rahmatullahi wa barakatuh.